Good morning, ladies and gentlemen. Bon matin, tout le monde. My name is Eric Lemieux. I'm the chairman of the 14th Swiss Mining Institute Conference. Je vous souhaite la bienvenue. Mon nom est Eric Lemieux. I'm a mining analyst from Montreal, or I should say Drummondville, Quebec, in Canada. Those who've heard my French will realize that it's not the French Parisian, but it's the Québécois. So I want to welcome you for this conference where we have 9 companies presenting today and 5 keynote speakers. The first keynote speaker this morning is Monsieur Claude Bégel. I call him Claude, Monsieur Hi-Ho Silver. Claude is an esteemed presenter, graduate from the Business School of Paris, different degrees, but he's an astute analyst in terms of knowing what's going on in the industry and having the contact. And his presentation this morning will be on the silver. He's got tremendous insight. So Claude, since we're on a tight schedule, I'm going to start your presentation, my friend. Bon matin.
Well, good morning, ladies and gentlemen, and welcome to the 14th edition of the Swiss Mining Institute Conference. We're going to start by a little film which made my happy days as a child. This is a video on the Lone Ranger. Okay, so you get the message. This is the Lone Ranger, and what he did in the Wild West was to have law and order come back to these difficult times. If he could come here in Wall Street and with his gun, he used to shoot the bad guys with silver bullets. Anyway, so our topic is a little ambitious this morning, but I think we should be. 10 times your money with silver stocks. Now, I tell you one thing, it is possible. I went to Peru in '93 with my friend Mark Faber, and we did 50 times on Buenaventura. So we're going to see today where we stand in the bull market, in the precious metal bull market. Review the fundamentals of silver and why silver outperforms gold in a precious metal bull market. Then we'll see a few specific situations. My last presentation in March, I was presenting the bull market in gold, saying that we should be buying the dips. Well, as usual, I probably bought the dip, one dip too early, but if I'm right in this, that this is a bull market, it won't matter much. Nevertheless, I should have done this presentation. We still have a young bull. If you look here, these are the bull markets in precious metals shares. This is time horizon. It is still early days. A bull market in precious metal stocks lasts for years. The fundamentals for gold are still extremely bullish. As you all know, central banks keep printing. The Fed says they might stop printing, but we have to see if they'll effectively do that. Good graphics from Democracy. This shows you how very small the gold assets are and how big the 1 quadrillion derivatives market is. Interest rates are low, and more importantly, real interest rates are low. It looks to me that the US dollar has peaked. It's had a huge run. It's massively overvalued. They have a huge trade deficit, trade deficit with Europe. And I tell you, it's much easier for Trump to tweet and get the dollar down than to get a really interesting tax reduction bill in the Senate. Political instability is widespread. We all know about this. And more importantly, today, we always, to be able to navigate these difficult markets, it's always important to understand sentiment. Now, even the diehard gold bugs are saying today it's a bad seasonality for gold. Don't buy any gold stocks before September because the summer is not good. On top of that, you've had a huge negativity coming from the mishandling of the GDXJ rebalancing. As Peter Haynes from TD puts it, this was the greatest wealth destruction in index history. In fact, in bull markets, summer is good for precious metal shares. It's definitely not good in a bear market, but in a bull market, shares between April and September go up pretty regularly. I recommended last time a company called Exeter. It was, for me, the best call option on the gold market. It's been taken over with a 60% premium by Barrick. I would have wished the CEO would have been a little more difficult and have a much better premium. Anyway, I'd like to replace this today with what I consider as the best call option on gold. It's International Tower Hill. Very small market cap, $75 million, $7 million in cash, but it's a huge company. They have the 6th largest undeveloped gold property with measured and indicated 9 million ounces of gold. This is huge. And Paulson owns 19%, so this has been thoroughly researched. Just in 2011, it was up here, it's down here. If it goes back to the highs, you're talking about 20 times. So, gold's appeal is still running high. So, what are the fundamentals for silver? Silver is like pretty women. It's attractive, but it's dangerous. So, cautionary statements. Gold is difficult to understand. Silver is even more complex. It's treacherous. It's erratic. Why? Because a lot of the components of this market, they can change dramatically. Mine production doubled from 1994 to 2015. Scrap was up 30% from 2009 to 2011. Photography was a third of the demand. It's practically disappeared. So you see, it's a lot of moving parts, and silver sometimes reacts to this, sometimes to something else. Nevertheless, rewards can be extremely attractive. In the hunt corner, silver went from $6 to $49 in 1 year. In less than 3 years, to 2011, silver went from $10 to $50. In the bull market, 2001, 2008, silver was up 16 times. Pan American silver, 17 times. In 3 years, from 2001 to 2004, Hecla, 19 times. And this is not a dinky toy company. Silver Wheaton, 19 times. Great Panther, who presents here very regularly, which proves it's a good idea to hang around this conference, was up 7.5 times in 1 year to May 2016. This company is now back flat on its back. It's probably a great buy today. In less than 6 months, in 2016, Kerr went up 10 times, Southern Silver 22 times. So what are the silver fundamentals? And why are they bullish? Production has peaked. There's growing industrial use, attractive jewelry market, and strong investment demand. So, I know we'll skip that, we can't see it much. But this is the statistics from the World Silver Institute. if you want to have all the key figures, they're free on their website. They are doing a great job. So silver production has peaked after this big increase. With scrap, we're talking about 1 billion ounces, which is only $16 billion, so it's a very, very small market. The scrap supply is at a 24-year low, and silver production should continue to decline. Why? Because 30% is primary silver mines, 12% gold mines, and the bulk of it comes from byproducts from base metals. Just the zinc companies, which has closed down, have shut out 20 million ounces of silver, which are not going to be produced anymore. The base metal boom is ended in 2011. And what's interesting for us if we have a position in silver is that even if silver goes up, since only 30% comes from primary producers, you cannot have a quick supply response. Like for gold stocks, there's a lack of exploration budgets, depletion of resources, lower grades are mined all the time, and there has been no big discovery since 1993. The stock above grounds are increasing, and that's also an unusual characteristic. In this market, more stock and silver prices go up. So you see it's a difficult market to understand. The reason is probably just that people hoard, and they're strong hands, they keep it. 3 countries produce 50% of the silver. So if anything happens in one of these countries, you can see the impact it can have on the silver market. Fresnillo, the largest silver producer, mines only 5% of the production, so it's a fragmented industry. And silver's growing silver demand, the growing demand in silver is, this market in fact is in a deficit, has been in a deficit for 16 years. So this industrial demand is eating up all the supply. Physical demand, you have 56% coming from the industry, 33% jewelry, 11% investments. So let's see first the industrial demand. Silver has unique properties: highest electrical conductivity, highest thermal conductivity, and antibacterial properties. This is why you always have new industrial applications. Just in solar panels, this market didn't exist in 2007, and now they're responsible for 80 million ounces. It was up 34% in 2016. So since you're all paying a lot of attention to this presentation, you saw the beautiful silver jewelry. Silver jewelry is doing well. You have a rising demand. If the prices go up too quickly, then of course you have a little dip for a couple of months, just like in gold. So what is the most relevant in the silver demand story? Is it the jewelry market? Is it new industrial application? It could be. But on the long run, what has worked the best is, the key driver is investment demand. We're talking here about 250 million ounces on a 1 billion ounce market. China is now a big consumer, and India also, where jewelry demand is up 600%. So you all know what happened in India. They suppressed the 500 and the 1,000 rupee bill. So of course, people didn't have any more money, so you had a drop in gold and silver consumption in India. Now they're reintroducing the new bills, but what do you think the Indians will do now? They'll be buying more and more silver and gold because the credibility of the government, which was already very low, is practically nil. The ETF holdings have been increasing tremendously. They're now 664 million ounces. That's a big growth. In 2007, it was only 220 million ounces. Now, if you look at the gold ETF holdings, during this terrible bear market that we had to endure since 2011, you had a 50% drop in these holdings. Now, look at this. This is the equivalent in silver. No redemption. Now, how can that be? Silver goes from $50 to $16, and people are not selling their silver. This means, ladies and gentlemen, that strong hands are holding the physical. It means that silver will go up a lot. And in bull markets, silver outperforms gold. Why does it outperform, or will it outperform? It's relatively inexpensive in inflation-adjusted terms. It went up to $50, it's back to $16. And more importantly, silver is extremely cheap relative to gold. The ratio, you take gold and you divide by silver, and you get the ratio. It's today 75. Now, the average from 1970 to 2015 was 56. In the Earth crust, the ratio is 20 to 1. In ancient times, it was 15 to 1. Today, you produce 9 million ounces, 9 ounces of silver for 1 ounce of gold. Today's ratio is 75. If we go back to the 2012 ratio of 50, silver will be already up 51%. If you come to the historical ratio of 15, the long term, you're up 604%. So you see the huge leverage which is possible. And of course, silver is a bargain compared to all the bubbles around. Stocks are overvalued. Bonds are in a ridiculous bubble. And real estate is at ridiculously high levels in most countries. So basically, maybe the best strategy for the decade is long silver stock, short Apple. Total cash costs of silver are reasonable. This means that silver companies are making a lot of money. So you're pretty protected because they usually have a lot of cash. So why is silver so volatile? One of the main reasons is that it's a small market. Here I have a few back of the envelope calculation. But all the gold ever mined in the world is 180,000 tons. That is a lot of metal, and it represents something like $7 billion. Now, since the beginning of times, half of the silver produced has disappeared through industrial consumption. So there's only left 777,000 tons, which represents $466 billion. If you look at more interesting numbers that influence more the market, if you take the total supply, for gold you're talking about 3,000 tons. That's $132 billion. For silver, 1 billion ounces. That's only $16 billion. So you see how easily the market can fluctuate. If any of you people buy a little silver, the price goes up. So here you have all the silver consumed, and that's what's left. Small numbers. So the other key reason that a lot of people fail to understand is that silver goes from changes status. So sometimes silver is just a commodity. So if it's in the oversupply, it can go to a ridiculously low level, way, way below cost of production. And then if you're in a bull market in precious metal, if people start to get nervous with their currencies, then it becomes a monetary metal. And then you have a huge re-rating. So today I would say we're sort of half-half. People consider it half commodity, half precious metal. Silver outperforms gold in bull markets. Here you have a few examples. So, silver is down. We're supposed to buy the dips. This is the chart of gold in US dollars. My impression is that this was the low at the end of 2015, and now we're going back up. A lot of people consider this downtrend as extremely relevant. If we break 1300, they'll be more comfortable. My personal belief is that they're looking at the wrong chart because the dollar is so overvalued that it massacres this chart. I don't think it's relevant. If you take the euro, the gold expressed in euro, you have a much more convincing bull market which started early 2014. Same thing for the precious metal shares, devastating bull market, huge pickup, correction, you buy the dip. Silver, same idea. Silver shares, huge run up in 2016, retracement of 61%, a Fibonacci 51%. It's consolidating. It should shoot back up to the upside. So a few examples of what could be of stocks you could look at. In the big caps, above $1 billion market cap, Hecla, First Majestic, Pan American Silver, Mag Silver. Hecla Mining, that's quality mines. They have huge long mine life. They're in North America. It's a high grade, low cost. They have $230 million in cash, so this is a pretty solid investment. They're doing massive profits. 39% of revenues come from silver, 39% from gold. So it is precious metal. Great management. Strike at Lucky Friday might be an entry point. First Majestic Silver. This is dynamite. It's the purest silver play. It has the highest beta to silver prices. The management created the company in 2002. They've successfully launched two other companies, Silver One and First Mining, which are probably buys also now. And their CEO, Keith Neumeier, is the leading figure in the silver market. He can get this stock back up. It's 7. It used to be way up here. Pan American Silver, I've recommended this stock quite a few times here. The reason is that they have a huge deposit in Argentina called Navidad, which is not permitted. It's valued at 0 in the portfolio. If it ever gets the permits, this big company, which has 7 silver mines, can really, really move. Friday, you had this little thing. Maybe it's the turnaround. Mag Silver has been, I don't need to introduce Mag Silver. It's the best exploration company. And on top of that, their joint venture partner is Fresnillo, who is the best operator in silver. It's high grade. It'll be one of the most economic deposits in the world, and they still have huge exploration potential. They also have Cinco de Mayo. It's another property they have. Here again, they have some permitting problems. Once that is resolved, it gets re-rated. Interestingly, you see early May, it looks like MAG has turned. So has quality turned first? Is MAG telling us something on the market? A few low risk, high reward mid caps. Great Panther, Alexco, Almaden Minerals. Great Panther Silver, you all know this company. They're regular presenters here. For me, it's the best mid-tier silver growth story. They can increase production by 75% in 2018. The market cap is very low, $200 million. They're fully financed. They have 2 profitable mines in Mexico, producing 4 million ounces. This could be a $5 stock in the not too distant future. It's probably a buy today because with this stupid rebalancing of GDXJ, the stock got massacred. They had to sell 14 million shares on a small float that's huge. Everybody who had to sell the stock did it. So probably we have a bottom here. Anyway, it's easy to control your risk by putting stop loss under the lows. Alexco, this company was producing with a profit in 2011. They had a bad deal with Silver Wheaton, so when the price of silver went back down, they were going to have losses. The CEO protected the investors and stopped production. He renegotiated the contract with Silver Wheaton, which is now much better. They're going to go back into production, and this production will be even more economical than before because they have made a huge discovery with 2 kilograms per ton of ore. Here you have a breakout on high volume. Maybe this has turned. But as you see, it's easy for this stock to go back up to where it was trading when they were producing. If it goes back to the 2011 high, it goes from $147 to $10. Almaden Minerals, it's one of my all-time favorites. The market cap is $200 million. It's been doing very well since March. They have over $25 million in cash. They have measured and indicated resource of 200 million ounces. Half of that is pure silver, so it's people don't understand it's also a silver company. They have a very robust pre-feasibility study with a 40% internal rate of return at $1,250. CapEx, only $117 million in Mexico. This, ladies and gentlemen, will be taken out. A few fun, more speculative, smaller companies. Orcana, they have that's a very unusual situation. So you have a company whose market cap is $27 million. $120 million have been invested in this project. The project is fully permitted. The project is fully funded to production. And they can start mining, they can start production within 3 months of the decision. So the day the CEO says, I'm going to produce, 3 months later they're in production. Then you have a huge re-rating of the stock. It's broken down the trend line, but it's such a small stock, I don't think this is very significant. But what is very, very clear is that this is an extremely undervalued situation. Dolly Varden is an exploration play. Market cap is $20 million. You're paying a very low $0.64 per ounce in the ground versus 1.6 on average. And what makes me confident on this exploration play is that Hecla wanted to buy them, but management knew they had something very big, so of course they didn't want to buy. They have a new CEO with Gary Cope, ex-Orco Silver. So I would say this ranks in a promising exploration play. Abra Plata Resources, market cap is $33 million. They have 155 million ounces of silver equivalent. This means that it's about 2 million ounces of gold. So you have 2 million ounces of gold for a market cap of $33 million. This is cheaper than Google. Their drilling starts again in June. They have a previous PEA, so it's easy for them to redo a PEA, which will be available probably within a year or so. They have $4 million in cash. Silver Standard owns 19% and management 14%. Again, a very, very undervalued situation. Bitterroot Resource, this is pure grassroots exploration. They have 29 million shares outstanding. The market cap is $5 million. They have an old high-grade silver mine, which was mined between 1874 and 1921. And the reason why I'm interested is that John Wright is involved, and he's the former COO of Pan American Silver and ex-director of Lumina Copper. Ladies and gentlemen, thank you very much for your attention. I hope I've given you a few ideas on silver. If you want to discuss anything further, I'm around for the whole day. Thank you very much.
Excellent presentation, Claude. Thank you very much. We are on a tight schedule, so I will not permit to have any questions. But yes, Claude will be around, and at the coffee break, if you do have questions, do feel free to intercept Claude and ask your questions on silver. I have the honor to present our next conference. Mr. Darren Wagner. Darren is a veteran geologist. Started his career with companies such as Noranda, which is now Glencore, and also Cominco, which is now Teck. Darren was part of the Thunder Creek discovery in West Timmins, which West Timmins was sold, if you recall, to Lakeshore Gold, which is now Tahoe, and that was a success. He's now involved with Balmoral Resources. He's the CEO. Balmoral is B-A-R-T on the Toronto Exchange. They're in northwestern Quebec. They were the recipient of the Discoverer Award of the Quebec Prospectors Association, and twice for the Grasset deposit, the nickel, and also for the Martinière Gold Project. So, Darren, the floor is yours, and I have the honor to shake your hand this morning because we didn't.
Thank you, sir. All right, excellent, very good. Yeah, as Eric said, we have this track record at just about anywhere I work. Ends up getting taken over at some point in time. I don't know whether that's me or just circumstances. Balmoral, after all the wonderful talk about silver, we're going to talk about a little bit of gold here. In particular, we're going to talk about high-grade Canadian gold, and that's always a wonderful topic. You'll have an opportunity to hear twice today about high-grade gold projects in the Abitibi region from ourselves and Cartier. And I think the fact that there's 2 of us here out of 9 companies speaks volumes about the area and the potential we see and that the investors see in this space. Our team are all experienced veterans. Claude did mention MAG. We did have the good fortune of being part of the original founding of MAG Silver, and Dan McGinnis, who obviously ran MAG for a number of years, is our lead director. All of the bodies here are experienced bodies. They've all had success in and of their own rights, have come together to work on this exploration effort in the Abitibi region. Just a couple of quick charts, just to remind everybody why you actually do invest in exploration companies, and why even investing in exploration companies in sideways to down markets can be a really good idea if you pick the right ones. This is West Timmins. This was our former day job. And out of the bottom in 2008, less than 9 months, and you're gone, and everybody goes home very, very happy with a nice return on a gold discovery. That discovery is actually made 2 years prior. Sometimes it takes the market a little bit of time to recognize the significance of a discovery, but the run up there very, very strong. As Eric mentioned, this for Balmoral in 2014. This off the back of our nickel discovery, which now sits as effectively a free call on the nickel market behind the Martinière Gold Project. But again, in a pretty soft market, a very strong return for our shareholders in that particular case. We operate in the province of Quebec, and solely in the province of Quebec, and there's a lot of good reasons to be there. Probably first and foremost is they actually pay us to be there. So for every hard dollar that we put into exploration in the ground, they refund us 28.5%, which allows your dollars that you invest in a company like Balmoral to go considerably further than they do in any other jurisdiction. Also a place where it takes me 3 weeks to get a drill permit. Not 3 months, not 3 years, but 3 weeks. We have certainty of title. We have exceptional First Nations partners in this part of Quebec. We work with the Grand Council of the Cree. This is a group that actually promotes and helps to sponsor mineral exploration projects and mineral development projects rather than try and stop them as we've seen in other parts of the country. And the Quebec government is strongly supportive. As a matter of fact, it has helped recently for us fund some upgrades in the local road network. We've seen a number of major projects come online in the province of Quebec, so you do have this certainty that if you find it, you're going to be allowed to build it, and actually you're probably going to get some help along the way from the government. We work in the Abitibi Greenstone Belt. This is the second largest accumulation on the planet of high-grade gold deposits. We've been mining high-grade gold in this part of the Canadian Shield for over 100 years. There's a long history, and thus it's an area where your costs are very well understood, where there's an extremely good and skilled labor force, where you have a very clear understanding of what makes a mine and what does not make a mine. And for that reason, it's a place that people want to be. It's a place that major and intermediate producers want to set up operations, and thus, for junior explorers like ourselves, it's a wonderful place to be because you can become the next domino. And we recently saw a similar high-grade gold project in the Abitibi region with Integra get tumbled over by El Dorado, who's a new entry into the belt, and become the latest domino on our slide. We change these on a fairly regular basis given the amount of M&A activity. M&A activity, obviously, for yourselves as investors into the junior exploration space is quite frequently the best return on investment, because typically you've had a run with the discovery, with the expansion of the asset, and then you get the quote-unquote close and the opportunity to cash in on your investment or to carry on with the incoming company. So as an explorer, this is obviously one of the things we looked at when we set up shop back in the Abitibi after having sold West Emmons. We also like to work in areas where there are mines, there are active mines, and thus you have that infrastructure already built out for you in the region. These are our neighbors. Just across off the western end of our property package, we have the largest gold mine in Canada with Detour. Massive open pit operation, relatively low grade at 0.8 grams, and we'll contrast that with the average grade of our Martin Air project, which is sitting closer to 8 grams, so about 10 times higher. Just 45 kilometers south of us and accessible on the existing road network is Hecla's Casa Berardi operation. All Casa Berardi does is print profits year after year after year. It's a high-grade underground operation, along with a couple of small starter pits. And we see a lot of similarities between what we're discovering and outlining at Martin and that Casa Berardi system. And on the base metal front, the other neighbor is Glencore, and they operate the Matagami camp just off the eastern end of our property. And that has some bearing, obviously, with Glencore owning a nickel smelter in Canada as well, to our nickel discovery at Grisette. On the infrastructure front, the infrastructure in the area is very good. We drive into the project. It's about a 3-hour drive out of Val-d'Or. It's remote enough to be non-controversial when it comes to future development. It's close enough that we can drive into the project and thus supply very cheaply. The main power grid sits just 17 kilometers south of us. And importantly, we own 100% of the project. We're not beholden to anybody. We have nothing that drives us other than finding more gold and trying to make our shareholders a healthy return on their investments. We also own a couple of projects to the south, 810, which we picked up last year, which is a pure grassroots gold exploration project, and N2, which hosts a historic reserve of just over 1 million ounces sitting adjacent to a small producer called Veza down further to the south on the Casa Berardi structure. You'll notice the thick black lines that run across the map. Those are the major fault structures. Those fault structures are really key. Those are effectively the pipeline that brings the gold into the local environment, and it's along these structures that you need to be located, usually within 2 to 4 kilometers if you actually want to find a deposit of significant size, and that holds throughout the Abitibi region. As a matter of fact, it holds true throughout most of the gold greenstone belts globally. So we'll look at Martin Air. Martin Air sits about halfway through our land package. It's our current focus. And it effectively is a project that is in resource delineation at this stage. So the quote-unquote discovery risk is largely out of it. It's now a question of how big, how many ounces, and what are the economics associated with those ounces. On a geological basis, it really sits between two major regional east-west structures, and effectively the movement on those structures cracks the ground open, allows the gold-bearing fluids in, likely from that southern pipeline. That's that regional fault system. There are a number of deposits, very similar to what you would see in a number of the producing mines in the Abitibi. We're not talking about one single entity. We're actually talking here about 4 deposits and about 15 other zones of mineralization within the greater Martinair system. And the system and the deposits all remain open in all directions. As you can see on the slide, there's not a whole lot of other development in this region, nor is there a whole lot of exploration in this region, which is excellent for us, which means the system is wide open to continue to grow. The summer 2017 drill program literally commenced on the weekend. That's a 25,000 plus meter program that adds to about a little over 12,000 meters we did earlier this summer, or this spring. We still have results pending from that spring program, so they'll pretty much dovetail nicely with results that start filling up your inbox from the summer program here shortly. I think the other significant thing about Martinair, it's not a retread. This isn't a project that survived the last cycle and didn't make it into production when gold was $1,500 to $1,900. This is a discovery that actually started to emerge in 2011, and actually the Bug Lake, the main part of the discovery, wasn't found until 2014. Therefore, it's a new series of discoveries that are still growing, and not something that's had a rehash. 2 mineralized trends here, in total almost 3.5 kilometers of near surface strike length, and now well over 2 kilometers of down plunge strike extent as well. Again, 100% owned. All the deposits come to the bedrock surface. One thing you can see here is there's not a whole lot of bedrock sticking out of the ground. That is the opportunity up here. As part of the reason that we came into this belt is that it's not the, I guess, the easiest place to explore. It's an area with extensive overburden cover, which means the prospector who has found the bulk of the major deposits in the Abitibi region really can't find anything out in this area. I actually have a very lovely bottle of scotch sitting on my shelf for the first of my employees who drags in a gold-bearing sample from surface here. I think that's going to go from a 12-year probably to a 20 before anybody finds one. So it's been sitting there for 5 years, and I suspect it'll sit there a little longer. So everything's completely covered, but it's not overly thick cover. It's just a complete mantle that hides the deposits, allows us to bring in high-tech applications on the geophysical and geochemical front to make the discoveries, and we're showing that that does in fact work very much like it worked for us in the Timmins camp to make the discoveries to the south that led to the sale of West Timmins. 90% of our drilling to date has been very shallow, basically surface down to 300 vertical meters, but we have now intersected the deposits down to 750 vertical meters, and they're all open beyond that. Excuse me. Keep the geology fairly simple. Basically, on the right-hand side of your slide, you can see that the Bug Lake gold deposits sit along a trend which separates 2 geological domains. This is an early formed fault, multiply reactivated, so we actually see multiple pulses of gold mineralization into that structure, which typically leads to the high grades. We will see grades in here up to almost 9,000 grams of gold in individual samples along that Bug Lake trend. Trend shows great continuity. This is basically just stripping off the overburden and showing you the heat map for the gold zones. So we see basically three primary elements there. We see the Bug North deposit and Bug South deposit. Those are separated by about a late fault that offsets them by about 75 meters, but effectively they're one and the same. And then deeper, we have what we call the lower steep, much less drilling on the lower steep, largely because it's deeper. All of the zones remain open. All of the zones plunge down to the southern, to the lower part of the slide as they go to depth. And what results is the fact that they actually line up as we go deeper into the ground, which makes for a nice, pleasant mining scenario as we go forward. 50% of the holes that we have drilled on the property to date, not just into the zones, but on the whole property as a whole, have returned assays in excess of 10 grams per ton, so about a third of an ounce. And that's the hallmark of a very good high-quality gold system, high-grade gold system. These slides are relatively noisy, but I think they emphasize the point that there is in all cases, what we typically see is a broad halo of gold mineralization with a high-grade core. And again, this is not atypical of the Abitibi. This is what we expect up here. Pretty much vertical orientations to the zones, and that high-grade core there sitting at the heart of the system. The broader halo, in the case of the Martiniere and the Bug Lake systems, likely does give us functionality over the top 150 to 200 meters to start life as a low-cost open pit operation, and then ramp down onto the high grade as we go deeper into the system. As I said earlier, we've now intersected gold mineralization here down to about 750 vertical meters. Again, that isn't a surprise out here either. The nearby operation at Hecla is now mining down at 1,200 and has intersected gold mineralization to 1,500 vertical meters. That's pretty typical of the Abitibi. The down plunge extent tends to be considerably greater for the individual ore bodies than the along strike extent. As you can see there, everything remains open, nothing's closed off. And as we're backing out to drill a little deeper, we're making new discoveries, and the horsefly that's shown here is one of those. Once again, broad halo, lower grade mineralization, high grade core, and again, a consistent feature of almost every zone of mineralization we've seen on the property to date, which I think there are now about 21 that we look at. This is just basically to show you that high-grade core intact. That's the plunge line. That's that southerly plunge line. We see this in all of the zones. And this, as you can see here, this one remains open down to depth. But that isn't all that Balmoral is. That is basically 8 square kilometers out of about 750 square kilometers that we now control along the detour trend. So we are explorers by nature, explorers by desire. And this year we'll see us run our first significant exploration program outside of the Martiniere and Grisette deposits since about 2014. And that program led to the nickel discovery at Grisette. So for the first time in quite a while, we'll get back to doing what we love to do and look to make additional discoveries in the belt. So we will be drilling 25 to 30 holes on exploration targets outside of the main system, in addition to about 25,000 meters within the main Martiniere gold system as we continue to delineate that and get it ready for its initial resource. That's exciting for our shareholders, it's exciting for my geologists, and it's exciting for me because we always love new things. One of those targets, one of those areas that will see a great deal of exploration this summer is what we call Detour East. This is about 40 kilometers away from Martiniere. And it's a property where in the afternoons, on a pleasant sunny afternoon when the bugs aren't too thick in your face, you can see the dust cloud rise as Detour blasts away to liberate gold across the border. So it's shadow of the head frame, or shadow of the open pit, in this case exploration, and it will focus on what is now a 13-kilometer long trend of drill indicated gold discoveries on the southern part of the property, and on a large target, about a 5-kilometer long target in the very northeast corner of the property. So we will be drilling a number of holes out here this summer. Those targets, in some cases, have been ready to go for a couple of years. We've just been preoccupied with getting the delineation work done at Grisette and at Martiniere. So we're excited to get back to doing this work, and so look for these results to you probably in the early part of August. And hopefully we have another golden hammer waiting for us from the Quebec discovery of the year. Did mention that we do have a nickel deposit. I don't come to Zurich ever to talk about nickel. I usually come here to talk about gold. But we do have a nickel deposit. Right now, with the soft nature of the nickel market, it does sit basically as a free future call within the company on the nickel market. It's a fairly rare asset. It's a nickel sulfide deposit with beautifully simple metallurgy. They're usually very complex. This one is extraordinarily simple. It's an open-ended deposit. We've drilled it down to 500 vertical meters. It remains open below that. It has large degree of scalability to higher nickel prices. But at the moment, I will tell you very frankly that at 420, 430 nickel, wherever we are at the moment, it doesn't have economics. That makes it right on par with about 60% of the nickel space that's producing right now. Nickel market obviously very, very soft. However, on a go-forward basis, if you're any of the high-tech applications that you want to talk about, that everybody loves to talk about, their lithium and their cobalt, et cetera, those all require nickel from sulfide sources, not laterite sources, to make them function. So we actually get to tuck this away and deal with it on our own terms and at the proper time. This is not an asset we would consider moving at this point. We have tenure on it. We own it for the next 20 years without having to spend another dime on it. So we can afford to be patient with it and look to extract value for the shareholders at the right moment in time. So what are you looking for from Balmoral in the near future? You're actually right now, you're looking for the announcement of the drill program. I'll tell you it's underway, and you'll see the announcement early next week. You're looking for the final results out of the spring program, and then you're looking for a bunch of results as we continue to expand the Bug Lake deposits over the course of the summer. I think if I'm keying you into what to look for that high-grade core to stay intact. That's really, as we go deeper, that's really the critical part. We're looking for new discoveries in that Martinair system. We have not yet run a drill program at Martinair and not made at least one or two new discoveries proximal to the main gold-bearing trends. So it's a gold system that still continues to expand. You're looking for us to probably deliver a resource to you on this towards the end of the year. It'll be a Q4 piece of work. We're looking for new discoveries because that's what we're known for, that's what we do. In particular, areas on Detour East that I talked about, the Finger Lake area that I didn't talk about, which is just to the north of the Martinair system and would actually have some bearing on the future development at Martinair. This is about a 5-kilometer long trend now that we've begun to make a series of discoveries on. They've been relatively quiet while we work out exactly what we've got on our hands. You'll see the first testing of the 810 property probably later in the year. That's a property down to the south of the main trend. And we may actually return to doing some work at N2, given the size of the historic resource there, later in the year, early into 2018. That summer program underway now. At Grisette will remain fairly quiet. That's, as I said earlier, the final hole we drilled in 2015, this was basically our key to shut down the program, was 10.5% nickel over 7.5 meters. That's a pretty good hole. And we went backward on the day that we announced it as the nickel market was falling apart. That pretty much tells you what you need to do as a CEO. So we did, but that sits there. Obviously, the next time the drills rev up at Grisette, that's where it goes, right there. There's district scale exploration potential there. And interestingly, around that nickel bearing sequence, there are a number of gold discoveries we made while drilling the nickel out. That's a situation, this nickel gold pairing, that's very similar to the Kambalda region in Australia, which hosts a number of both nickel and gold mines. So at some point we do need to return to the gold exploration out there. I don't know that we'll necessarily do that this summer, but we do have things like 200-gram gold discovery sitting there for us to go play with. So those are pretty exciting things to be sitting sort of quote-unquote back shelf inside the company. No warrants outstanding on the company. All the options are internal. About $7 million in working capital here. What I talked about today was about a $5 million program. So unfortunately, I can't sit up here and tell you I won't finance. I'm an explorer. I do finance, but we typically do one a year, and that's really to put away the money for next year. So 2017, what I talked about today, already fully financed. At some point, we'll book the money for 2018 and move forward from there. Market cap is about $85 million at the current time, so there obviously you can see that there's some value built in there for the gold asset. And our strength really is in our retail and shareholder base and in our relationships, and it always has been that way. So I thank you for your attention today. I hope you have a great day with the rest of the companies here, and thank you, sir.
Well, thank you very much, Darren. Great presentation.
Big round of applause.
Finger Lake, I know it as Lac du Doigt. And so remember Lac du Doigt. Maybe just a little disclaimer, I am an analyst, and Balmoral is a company that I do cover. So we're going to leave northwestern Quebec and go towards Idaho. I have the honor of presenting Mr. Greg Lindsay, President of Otis Gold Corp, triple O on the venture. Got it. So Mr. Lindsay has over 20 years of experience in corporate finance, investment, banking, business development in North America and Asia. Just very quickly, he was the CEO of Magnum Uranium Corp, which was sold to Energy Fuels in 2009. I'll keep it very short. Greg, I'll ask you to come on the stage and introduce us, Otis Gold Corp. So, pointer and move forward. Okay. Excellent.
Thank you very much, Eric. Welcome, everyone. I appreciate you coming out to hear this story. Just in conjunction with this presentation today, we do have a disclaimer here that should be read in parallel to this presentation. I am, as Eric mentioned, the Chief Executive Officer, President, and also the founder of Otis. We're developing gold projects in the state of Idaho in the United States. We have 4 projects undergo. The project that I want to talk to you about today is something called the Kilgore Gold Project. And I'm focused on this project, number one, because it has a fairly large resource and it's a growing resource, and it started to generate some strong interest in the markets from strategic investors and institutional investors, and it's really the cornerstone of our company. And what we have at Kilgore, and I want you to keep this in the back of your mind, we do have about 820,000 ounces of 43-101 compliant resources. However, you'll notice our grade is low. The grade on this deposit on a 2012 resource is about 0.6 grams per ton. A couple of things to keep in mind. This is an open pit heap leach gold project. It is a low strip ratio. It's got very good metallurgy. Probably most importantly, in 2015 and 2016, we've been stepping out to the north of our deposit as well as down underneath the existing deposit, and we've been experiencing intercepts that are much thicker than the average size of the existing 2012 resource and of much higher grade. And that's what I want you to keep in the back of your mind and really the focus of the whole story here. Another project that we get no value for at Otis, but I do want to just talk about it for a couple of minutes. It's our Oakley project. It's a gold-silver project. We have 100% interest in it. There is a small resource on it, 160,000 ounces. There has been some interesting drilling out there recently. We got about 123 meters of 0.7 grams per ton. So the deposit does have some interesting growth potential, but what we're really excited about, we just started a field program out at Oakley a couple of weeks ago, and we're focused on a target there called Matrix Creek. It's about 350 meters by 200 meters wide, and we've done some sampling out there that's averaged about 1.7 grams per ton gold equivalent. And what's really exciting is there's a lot of silver out there. We've had silver hits up to over 300 grams per ton. As we speak, we're in the process of doing a program of 1,350 soil samples out there and 40 stream sediment samples. We'll be doing some ground mag out there. By the end of this year, we'll have a really good idea of how to approach this project from a development perspective. But again, the focus of what I want to talk to you about is our Kilgore project. So let's talk about briefly about Idaho. Many of you may not be familiar with it, but it's a very friendly mining state. There's a lot of activity in the state, both historically and today. So I just want to talk to you a little bit about that. Up here in the northern part of the state, something we call the Idaho Panhandle is the Silver Valley. Very high-grade underground silver mines. You'll know the name Hecla. They operate the Lucky Friday mine. Lucky Friday just sunk the deepest shaft in the United States at 650 feet. Down in the southeastern portion of the state, we have the phosphate belt, very large open pit phosphate mines. Large companies like Agrium, Monsanto, J.R. Simplot are operating these mines. Thompson Creek in the center of the state, it's the world's largest open pit moly mine. We also have a company that you may be familiar with, Midas Gold, developing the Stibnite project, which is another large open pit gold mine that's going through a large permitting process. From the gold side of things, long history of gold mining in the States, a lot of alluvial and placer mining historically, but there's also been a number of very successful open pit heap leach gold mines. Specifically, you had the Bear Track mine owned by Meridian Gold, which is now owned by Yamana. They took about 650,000 ounces out of that mine. And then the Black Pine Mine, which was operated by a company called Pegasus Gold, took about 450,000 ounces out of there. The reason I mention these two mines is that they have similar styles of deposits to what we have at Kilgore, and they were projects that were discovered, developed, permitted, they went into production, and they went through successful closures, and they're good news stories in the mining front in the state of Idaho. So really lots going on in Idaho. Again, it's a very mining-friendly state, and it's been a fantastic place for us to operate. To give you a little bit of idea about our company, a little flavor here, 160 million shares outstanding. We've got about $7 million in the bank, so we're fully funded for all of our exploration and overhead for the next 12 months. Management and directors, officers own about 26% of the company at this time. Probably most importantly from an investor perspective, we frankly struggled out in the market over the past couple of years with the downturn in the market, but I've been very successful in raising capital out of the United Kingdom. So as part of our shareholder base, we have about 35% of our stock held out of the UK by high net worth individuals. And more recently, and it's been a big step forward for our company, in February, a large Canadian mining company, Agnico Eagle, acquired a 9.9% position in our company at 35 cents a share. To give you some context, we're trading at about 30 cents a share right now. So that was a very positive development for our company and has created a lot more interest in the company from the market. We've had some institutions starting to buy stock in the open market, and just as importantly, in terms of analyst coverage, I can tell you that just last week, Canadian operation PI Financial just initiated coverage on our company. So we're really excited to have some conventional research on our stock, and most importantly, the fact that we've got this strong financial partner in Agnico to help support the development of Kilgore is fantastic. As Eric kindly mentioned, corporate finance and investment banking, don't need to go into my background. The guys who you're investing with, Mitch Bernardi and John Carden, gray hair, long history in the Western U.S. mining community, focused on gold. They've got deposits to their credit. They've got deposits that have gone into production. For instance, John was the identified and developed the Lamefoot deposit, which was the highest grade, lowest cost producer in the history of Echo Bay mines. They're great guys to have on my team. Two other people I want to mention, Roger Norwich, he's one of our directors. He's based out of the UK. He was a founder of a company called Rio Alto, built that company up and sold it to Tahoe Resources. And a bunch of the shareholders that supported him in that transaction are now shareholders in our company. We've also been working on, as we moved into more from an exploration to a development phase, we've been bringing in people like Eric Klepfer, who's focused on permitting, and Michael Vint, who works for Endeavor Financial, a large mining finance house. He's a mining engineer, and he's really focused on doing all of the technical review for mining projects for Endeavor, and he's helping us out on that end of our business. So history of Kilgore. This is actually a project that produced historically. In the 1930s, this produced as a high-grade underground gold mining operation. Back in those days, the gold would have been found in the creeks and streams at the bottom of our project. The old-timers moved up the hill and found where some high-grade chutes came out at the surface. There's 15 old adits that are collapsed on the project. There's an old tram line. So that's how things got going at Kilgore in the 1930s. Second World War came along. The United States stopped all production of metals other than strategic metals used in the war effort. And people kind of forgot about Kilgore. Fast forward to the late 80s, early 90s, a number of large companies came along and started to develop the open pit heap leach potential out at Kilgore, the bulk tonnage story. And the main one, the most important one that was out there, Echo Bay Mines, they were out there from kind of 93 to 96, and Kilgore was actually going to be their next production story. It was a small mine story, 45,000 ounces a year. The grade on the identified pod that they were going to start mining was about 1.28 grams per ton. Relatively short mine life, but back in those days, that's how mines got going. That was in a $350 gold environment. Unfortunately, the price of gold at that time dropped down to $250, and Echo Bay walked away from all of their development projects, including Kilgore, but they had completed a whole range of detailed engineering work, metallurgical work, etc. on the project. So keep that in the back of your mind. The other things to keep in mind, we own this project 100% and there's no royalty burden on it, which is a strong position to be in. The other thing is we're very good access to this project. We're just off of a major interstate I-15, about 50 miles off of that road. You can drive a two-wheel drive vehicle right up to our project. We've got rail that runs parallel to the interstate. We've got power to the bottom of the hill. So that's coupled with the fact that we're in a place called Clark County, which is, to give you some context, it's the size of Rhode Island, but there's only 930 people in the state, and it's also, or in the county, and it's a very, it's a low-income area of the United States, which has some positive benefits from a permitting perspective. So just, I won't get into a lot of detail on the geology here, but this is a volcanic hosted epithermal gold system. And what you're looking at here, these green circles, are a string of volcanic calderas which had their origin at something called the North American hotspot. And these, the oldest calderas, which are 14 or 15 million years of age in the northern part of Nevada and the eastern part of Oregon, are the home to many well-known volcanic hosted epithermal gold systems that have produced historically and continue to produce today. What we have at Kilgore is the same thing as you got in the northern part of Nevada. It's just much younger rocks. As I mentioned, we're on the northeast margin of something called the Kilgore caldera. So this is a very large volcanic caldera. We're right on the northeast margin of it. This is a caldera that's about probably 60 miles across, so it's a very large caldera setting. The main host rock out here, again, I'm not going to get a lot into the geology, but the 820,000 ounces that we have is hosted largely in something called lithic tuff. And where we see a lot of growth potential in our deposit is in an underlying sandstone unit called the Aspen Formation, and I'm going to talk a little bit about that. So why did Agnico get excited about this project? Well, this is just a grade thickness map of our deposit. And what you see here is as we started to move up to the northern end of our deposit and do step-out drilling in 2015, we started to hit hits in something called the crab claw. You'll see really strong hits. The best one was 94.5 meters of 4.2 grams per ton. Keep in mind our deposit's 0.6 grams per ton, and the average thickness of it is about 50 meters. So we were stepping into some areas where the grades were much better, and some of these intercepts were thicker than what we had been experiencing in the main part of the deposit. So that caused us to start getting quite excited, and the market started to get a little bit more interested in what we were doing. And when we went, this is a cross-section through this area that we call the crab claw, where we got those higher grade intercepts. And this is what we found. This underlying sandstone unit had been up-faulted in something called a horse block. And all those hits ran across the main controlling fault out here called the Northwest Fault, and all ended in open-ended mineralization in this underlying Aspen Formation. So we went and did some work on, this is a long section through the deposit, and what we started to realize is the people who drilled this deposit, Echo Bay specifically in the 90s, they would drill through the lithic tuff, and when they would hit this underlying sandstone unit, they would stop, even though you can see all of these drill holes ended in open-ended mineralization in this underlying unit. Why? It's a $350 gold environment. They were looking for a shallow gold deposit, so 500 feet kind of they would go down and they'd stop drilling. The other thing, you get better gold recoveries up here, about 80 to 85% at 1.5-inch crush. The metallurgy isn't quite as good down here, so that's the other reason they didn't look at this. But because of the higher grade nature and these thick intercepts, last year we went out and did a 10,000 meter drill program focused on targeting this underlying aspen corridor. And without going through all of these results, we just basically had 100 meter plus intercepts of averaging 1 to 2 grams per ton. And this whole area, which is about 450 meters long by about 135 meters wide and anywhere from 65 to about 125 meters thick, up at the north end, 85 meters of 2.5 grams, down at the south end, 70 meters of 2 grams. Those were the last holes that we drilled at each end of this drill pattern. And again, what we found, and this is the big story that got Agnico interested, was this whole aspen formation is really coming together. So this is mineralization that's underneath the existing 800,000 ounces, and it's what's carrying the future of this deposit. The second thing that got them excited about the deposit was the fact that this is just looking at our whole claim block. It's about 37 square kilometers. This red blob is the deposit. This is the main controlling fault out here, the Northwest Fault. You'll see a couple of cross faults or radial faults at the confluence of the Northwest Fault and these cross faults. That's where you get your highest grade mineralization at Kilgore. People were never excited about some of the other targets that we had out at Kilgore. Why? Because I was sitting on an 800,000 ounce, 0.6 gram per ton resource, and people were concerned, well, that's all you're going to find is more 0.6 gram per ton stuff. Now that we've been able to show that the deposit is increased in size, and most importantly, the grade of the deposit is going to be coming up, these other targets start to become much more compelling. And so Gold Ridge, Prospect Ridge, they've got the exact same geophysical, geotechnical, basically the exact same geologic features that we have at Kilgore. And these targets are starting to become much more interesting to the market. Specifically up at Gold Ridge last fall, this is our deposit. We did a ground mag survey from our deposit all the way up to Gold Ridge. And what you're seeing here with these lines is they're all the identification of new fault structures that we were previously unaware of. So they're parallel to the main Northwest Fault, and they're also cross faults that are parallel to the established cross faults. So this lattice work of fault that is tied together with strong gold anomalies that are in the soil, some arsenic anomalies, and some other things that are out there are really good signatures that there's a strong potential for mineralization up at Gold Ridge. We see the same thing down at what we call Prospect Ridge. The other really important thing about this deposit, it's the last thing I really have to say, when you walk away from this presentation, think about our metallurgy. Most junior companies don't talk about metallurgy. It's always too early for us to look at metallurgy. We want the deposit to get bigger. That's usually because there's problems with the metallurgy. That is not the case at Kilgore. It's one of the best features of this deposit historically. The gold comes out of this ore with cyanide leaching both very quickly and at large crush sizes, and that's going to lower your mining, it's going to lower your capex, it's going to lower your mining costs, and it's a great feature of this deposit. So that's the close of my presentation. I mean, what you got in terms of walking away from this is we have 100% interest in the Kilgore Gold Project. We've got an extremely strong financial partner and mining partner with Agnico Eagle. We're fully funded for all our exploration for 2017. We're just starting up a $4.3 million exploration program out at Kilgore, 8,000 plus meters of drilling to expand that Kilgore deposit. We're going to be doing ground mag over the entire project block. There's just a lot of work that's going on. And the other thing to keep in mind, you've got some of the strongest drill results that were bulk tonnage drill results that were drilled in the United States last year, and we're excited about delivering some more of that kind of drilling to the market this year. So thanks very much for your interest in coming out this morning. I'm around for the rest of the day. If you have any more questions, please drop by and say hello. I'd love to chat with you. Thank you very much.
All right, excellent presentation. We're going to jump right into the next great Panther Silver. I have the honor of presenting Mr. Robert Archer. He's a veteran. I want to highlight that he does have his colleague Samuel Maw, who's corporate development, recent addition. A lot of experience in M&As with Silver Wheaton, I believe. And Robert, well, he, like I said, is a veteran, worked for Newmont Gold, Rio Algom, Noranda. I believe there's others, but Placidome. And from Idaho, we're moving to Mexico. Idaho Silver, my friend. 20 minutes, right?
Yeah, thanks, Eric. Okay, great. Thanks very much, Eric. Good morning, everyone. I think many of you are familiar with the Great Panther story, but the key thing I'd like to focus on this morning is our new acquisition in Peru. We've been known as a Mexican producer throughout the company's history since I co-founded it in 2004. I'll give you a fairly brief update on our operations in Mexico because I would like to focus on the Peruvian acquisition. We'll be making some forward-looking statements regarding production and the acquisition itself, so I encourage you to do your homework. But just as a brief overview, we are primarily a silver company, but gold makes up a very large part of our operations as well. So we're more than 90% by revenue, precious metals, a small component of lead and zinc from one of our mines in Mexico. We're unhedged, no royalties, no streams, everything's owned 100%. We have a very strong balance sheet at the moment. This is one of the things that separates us from some of our peers in the industry. We've got $53 million in cash, $69 million in working capital, no debt, which puts us in a very strong position, not only to bring the Peruvian acquisition into production, but to continue working on additional acquisitions beyond that. Through the 5-year bear market that we've recently experienced, we demonstrated that we're very disciplined in our operations. We've got our cash costs down significantly, such that even when silver was trading just over $13 an ounce, we were still actually making money at that point. And so with metal prices moving back up, cash flows obviously moving up as well, and so it positions as well for future growth, which, as I mentioned, has been organic to this point, but more on the acquisition side going forward. So just a quick snapshot at the cost side of things. You can see on the left-hand side our cash costs have remained very low, down in the sort of $5 per ounce of silver range. That's net of the byproduct credits, and as I mentioned, gold is our main byproduct, so certainly a nice byproduct to have. On the sustaining cost side of things, which includes all of the capital costs for the company, everything that you need to do to keep an operation running smoothly and ensure the continuance of the operation going into the future. The reason it's come up just in the last couple of quarters is purely because we had a capital project, capital expenditure at our smaller operation in Mexico, where we're starting up a new tailings dam. We needed to refurbish the plant, add some more equipment. We actually shut down the plant for 4 months, so we weren't processing anything during that time, but we did continue to mine. But the cost of that project, which was only about a little over $3 million, that does factor into the all-in sustaining costs. So that's the reason that that's come up just in the last couple of quarters. But that project is finished now. Those expenditures are done. So you'll see when our financials for Q2 come out that they're starting to come back down again. And by Q3, things should be back to normal, more in the $11 or so range. On the revenue side, obviously revenues are tied to metal prices, and so with metal prices coming back up, revenues should continue to be stronger. And as far as operating earnings go, this is essentially your gross profit from the mining operations. And similarly, more metal prices come back up, and we maintain a lower cost profile. Profit margins will improve going forward. So just a quick look at where we are. You can see in Mexico, the main operation is in central Mexico at Guanajuato. A smaller operation up in Durango State at a little town called Topia. The new acquisition in Peru, just east of Lima. And for a silver company, Mexico and Peru are the top two silver producing countries in the world. So it's an obvious place for us to be focused, and we'll continue to focus on those two countries. Mexico has more primary silver producing mines than any other country in the world, whereas Peru has the largest silver resources of any other country in the world. So it's two obvious places for a company like Great Panther to be focused. Just zooming in quickly into Guanajuato to show some of the land holdings in the district. You can see where the main operations are. Just get the right button here. Oops, sorry. There we go. Right here is the main operation just on the edge of the city of Guanajuato. Satellite mine at San Ignacio. We're just trucking the ore back to the processing plant here. But essentially everything in this district is within trucking distance. These are all paved highways. We have an international airport right here. Leon's a city of about 3 million people. So we have excellent infrastructure within this area such that if we can develop the small resource that we already have on the El Harcon project here, then that's also within trucking distance back to the plant. So we don't have to develop a huge deposit that justifies a standalone operation and a large expenditure. When we discovered mineralization on San Ignacio back in 2010, we had it in production within 3.5 years at a cost of about $3 million, simply because we didn't have to build and permit any additional infrastructure. So it's sort of very, very well positioned for additional growth within that region. So at Guanajuato, again, you can see this is a very low-cost operation, about $250 or so on the cost per ounce as far as operating costs go. Sustaining costs a little bit higher. We need to do quite a bit of drilling and mine development because we're operating 500 meters below surface. And this operation accounts for about 3/4 of our total production. Most of that is coming from the San Ignacio project, as I mentioned, just west of town, trucking the ore back around to the processing plant here. We've been operating in this area here. These blue lines represent the underground workings where we are currently. And just recently we've been stepping out, following the veins down in this direction where we've been getting some very good results. Right now, as I say, this is about 60% of the production going through the processing plant. And the new drilling, just a close-up of the project. New drilling stepping out in this direction here. You can see a little bit more detail. Where these two vein trends come together, there's a thickening where they join, a little bit like if you can imagine a wishbone type situation on your Christmas turkey, where the two bones come together right at the joint. It's obviously a lot thicker. So we intersected a little over 19 meters of 6.4 grams gold and 260 grams silver. So very, very nice intersection for us. And we're currently driving an access way from underground from the existing workings up in this area down to that thicker area in order to further develop that from underground. So it certainly bodes well for this project and for Guanajuato in general. We still have lots of work that we can do to follow this vein trend down this way and also up to the northwest, and we're currently drilling up in this region up here as well. Just at the smaller mine in Durango, this is the one where we've just been doing some work on the processing plant. So as I mentioned, the plant itself shut down for about 4 months, but we did continue mining and stockpiling the ore through that period. We're mining from about 9 different veins in the district. The processing plant is right here on the edge of town, and so we just truck the ore from the different veins back to here. This is a high-grade, narrow vein operation, so it tends to be a little bit higher cost. but the grades are quite a bit higher. You can recall over at Guanajuato and San Ignacio, the silver grades are running sort of 150 to 250 grams per ton. At Topia, they're more than 400 grams per ton. So it's a very high grade operation, and that compensates for the higher costs, the higher operating costs. So now that we're finished upgrading the plant, we finished the commissioning towards the end of May. We're back running at full capacity now and processing all the ore that we stockpiled during those 4 months of shutdown. The plan is to work our way through that stockpile while we continue to mine on the current operations, such that we will catch up by the end of the year all of the 4 months of stockpiled ore. For that reason, we haven't changed our guidance for the year. We're still looking at about 4 to 4.1 million ounces silver equivalent. Cash costs around $5 to $6 per ounce, and looking at sustaining costs, we're probably going to come in around the lower end of that, so somewhere around $14 per ounce. And so you can see it's down quite a bit. That's the average for the year, so that would include the 19.5 that we saw in Q1. So it demonstrates the fact that that was just a temporary thing because of the extra capital expenditures. Okay, so moving on from the existing operations, every mining company needs to have a good pipeline of projects. You need to keep growing. Mining, as we know, is a non-renewable resource and a non-renewable industry, and so you need to have a constant feed of new projects coming in. And as we moved San Ignacio from discovery back here all the way through the pipeline to production, we need to keep following that with other projects in order to ensure that the company continues to operate and to grow. So I mentioned Del Horcon, which is the other one in the Guanajuato district that we're hoping to move up through the pipeline with some additional drilling. But more importantly, right now, we're just in the process of closing an acquisition on the Coricancha mine in Peru. This is on care and maintenance at the moment, has been since 2003, but our goal is to bring this back into production hopefully by the end of 2018, and therefore move it from this category back up into here. This would become our third operating mine. And so this is just what our growth has looked like since starting the company in 2004. The original business plan was to get into production quickly, and we did that by 2006. And you can see how we've grown our production organically through that period over the last 10 years or so. But we've reached a point now where we're essentially at capacity on the operations, and so we're more or less flatlining at the moment. And in order to keep growing, we need to do so through additional acquisitions. And so the Coricancha mine represents the first step in this next phase of our growth. And we do intend to continue looking for and acquiring other projects like this. And to that end, we've just, as Eric mentioned, hired a new VP Corporate Development, who's here with me today, Sam Ma. And we've also just hired two other new vice presidents, a new VP Exploration and a new VP of Operations as well. And so really building up the team. And this also fits in to a large degree with my own decision to step down later this year, bring in a new CEO to carry the torch forward, so to speak, into this new phase. We just thought that rather than bringing someone in midstream, partway through this next phase, that better to do it now, where that the new individual would be coming in on the ground floor and really have more of a sense of ownership in this next phase, and perhaps even help to target the next acquisition for us. So there's no particular time frame on that. I'm not going anywhere. I'm going to stay on the board and be very active, particularly in helping the company grow in Peru and try to replicate the success that we've had in Mexico. So looking forward to continuing that. And given that I'm still the largest non-institutional shareholder in the company, I've got a significant financial stake in making sure that we do continue our success and that our goals are properly aligned with our shareholders. So just a few slides on Coricancha itself. This really represents a near-term production opportunity. We do hope to have this in production by the end of 2018. We're going to conduct a pre-feasibility study this year, and we expect the acquisition to close perhaps next week. There's a good chance that once I get home tomorrow night, I'll be able to perhaps relax a bit for the weekend before getting back on a plane and heading down to Peru on Monday to take possession of the mine and change the name on the gate. And we're pretty excited about getting going with this. So. With that, we will be pushing forward, and we've already started a project to update the resource, and that should be finished hopefully by the end of Q3. So just a couple of shots here. You can see the plant and the mine. It's only 90 kilometers outside of Lima, so it's very close. We're right on the Central Highway, which you can see right here. So in terms of infrastructure, it's tremendous. You're only a 3-hour drive outside of the main city. And we have a river right beside us here, hydroelectric plant just off the photo. So power, water, access, all of these things are really not an issue. In that 90 kilometers, which is a pretty windy road, you actually climb from sea level at Lima to 3,000 meters elevation, which is where the plant sits right here. The mine is in this mountain across this valley and goes from 3,000 up to about 4,000 meters. So still not too high by Peruvian standards. There are mines over 5,000 meters down there, so being able to operate at 3 to 4 is pretty good. But everything's fully permitted. It really just requires us to go through this PFS process and bring the mine back into production. The resource that we're updating, I just throw this up here to indicate that it is historical, dates back to 2012, and that's why we need to update it. This was done at $22 silver, so we'll be using current metal prices. So these numbers will drop. There's no question of that. But at this point in time, I can't say what the new numbers might be. But keep in mind that this is just a classification exercise. That once we go through that update, the mineralization is still there. So should metal prices come back up again, we can redo the resource base again. But it is a very significant resource, and we're pretty excited about getting going on this. So just a quick word on the agreement itself. This project is currently owned by Nearstar, at least for a few more days. And they're getting out of the mining business entirely, which meant that they were, you could say, a motivated seller. They were getting out of Peru, and this allowed us to negotiate a deal that is a risk-sharing model and one that works very well for us. So we'll only pay $100,000 on closing, and then we don't have to pay anything else to Nearstar until the mine is up and running, profitable. We've paid back all of our investment to get it to that point, and only then do we pay 15% of our cash flow for a 5-year period to a maximum of $10 million. So if the project works and metal prices come back up, we'll be more than happy to share the profits with them. If it doesn't, then we're not just lining their pockets while we're left with the liability. It works very well for us. During that time frame, we also don't assume any liabilities for reclamation or anything like that. So they'll take care of any of those issues and keep the bond in place for the next 3 years. So I've mentioned most of these catalysts will be closing very soon. An update on the exploration results, which I didn't mention. We actually had this project under option for a year, spent $2 million, did a lot of drilling, got some very good results that encouraged us to move forward with the acquisition, but those were never actually released because we terminated the option. So those will be coming out fairly soon as well. We're going to initiate the pre-feasibility study, update the resource, and hopefully get to a production decision by first quarter of next year. Just briefly on the capital structure, we've got about 168 million shares on issue, very liquid stock, trading in New York and Toronto. Right now we're trading about 2 million shares a day. And importantly, we're trading at about a 52-week low right now. And the reason for that is that we saw in February, after we went through last summer's doldrums, and just mentioned this little peak here. First off, when silver ran to $20 last year, we were able to finance right at this point here, so it put $30 million in the bank. It was very well timed, and that put us in a very strong position to go through the acquisition of Coricancha and be fully financed to production. But when the market came back up to a peak here in early February, there was a massive sell-off, perhaps just through profit-taking throughout the industry. So a big correction here, and then we're starting to stabilize. And then in April, there's an ETF, an index fund in New York called the GDXJ, the Junior Gold Miners Index. They announced that they were restructuring the fund and buying about 20 or so new companies. And in order to do that, they had to sell down the companies that they currently held. And so they published a list of those companies and how many shares they were going to sell in all of those companies. So they came out in April saying that they were going to sell down about 14 million shares of Grey Panther, which was about 8% of our entire issued shares. So a very significant amount. So of course the short sellers jumped on that right away. We got hit pretty hard, and then nobody wanted to catch a falling knife. And so until the rebalancing actually went through, which was just last Friday, the stock's been had a lot of downward pressure on it, and we've managed to stabilize a little bit. But as I say, we're at about a 52-week low right now, and so it's one could say that now that the rebalancing is out of the way, and all of this was purely market-driven, had nothing to do with fundamentals of the company, that we're in a very strong position for a rebound. And it just shows how it dragged down the entire industry. So all of our peers have really been dragged down over the last year. Very strong leverage to silver. And so just to wrap up, we are a low-cost producer, and great balance sheet right now. It puts us in a great position to continue our acquisitive growth, and we've demonstrated that we can successfully grow production while keeping our costs down, and now expanding into Peru to hopefully replicate the success that we've seen in Mexico. So with that, I thank you for your attention, and enjoy the rest of the conference.
Yeah, I'm a little bit saddened that Robert took his decision, stepped down, but I guess, yes, it's probably the turning point to do it. So congratulations, Robert. I have the honor of presenting our next conferencer, Philippe Cloutier of Cartier Resources, ECR in the venture. Philippe is a veteran geologist, specialist, I would say, of the Abitibi. He worked for Noranda, was part of the discovery team that discovered the Belle-Allard South deposit in the Matagami camp. I'm just going to make sure that this works correctly. As I say, he's based out of Val-d'Or in the Abitibi, and our Cartier is really focused in that area. And so, Philip, I'll ask you to come on the stage and introduce your company. Effectively, I just want to highlight that Philip is the founder, and that was founded about 10 years ago. Doesn't make us younger, but
okay. So how does it work?
So this is the pointer.
Yeah.
Oh, I don't know what happened there. And this is to move forward and back.
Perfect.
So you got to stay centered.
Yeah.
Thank you.
Well, thank you very much. Forward-looking statements, that's what explorations do. We always look forward, so we look backwards sometimes, as you'll see this in this presentation. The share structure, very rapidly, 155 million shares outstanding, but very tightly held. We have 19.9% held by Agnico Eagle, very recent investor in our stock last December. And then we had JP Morgan as well take 9.9% of our stock last, I think it was basically end of May. And so we went from last year having about $800,000 in the bank to this year having about $14 million in the bank. Last year, no hope in doing a sizable drill program. This year, we've just recently announced a 50,000 meter drill program. Last year, we had about no interest in our company, and this year, well, we have several senior investors and strategic alliance people. And throughout this presentation, I'm going to present to you why I think we're going to deliver on 3 important projects that we think might become the next mines in the Abitibi. And to do that, I'll run you through some of the basics behind our strategy, our exploration strategy. We explore exclusively in the Quebec portion of the Abitibi Greenstone Belt. And on this slide, I want to take some time to present 2 basic concepts. Right here, you have the Eleanor discovery, discovered by Virginia in 2002, sold to Goldcorp in 2006, and finally in production in 2016. So that's the time frame, 2002 to 2016 for that solo red dot up here in northern Quebec. Very large deposit, high grade, and has to be so because it's remote, all right? We call that frontier exploration. In the Abitibi, and I haven't even shown the red dots in the Ontario side, but in the Abitibi, Quebec portion, well, you've had all these deposits here. Detour, Casa Berardi, Brace Mac, Bachelor, Narstar, Canadian Malartic, et cetera, et cetera. The difference here is that not one of those red dots was a new discovery. Not one. They were all discoveries that had been made in 1930s, 40s, 50s, 60s, and 80s, and that had been shelved or forgotten for a whole bunch of reasons. Low metal prices, companies that would leave the district to go somewhere else, all right? So not one of them was a new discovery. We call that Renaissance exploration. So in the same time frame as Eleanor, from 2002 to 2016, you had large deposits, low grade. You had small deposits, high grade. You had deposits discovered and delineated by junior companies and senior companies. All of that in the Abitibi Greenstone Belt. And the advantage here is that you have access to, or you're proximal to, infrastructure and qualified workforce. And it's an area that's steep in mining culture and that has a great amount of social acceptability. So that's why we chose in the most recent times to focus in that area and acquire projects that had meat on the bone, that had ounces in the ground. And I'll present those 3 projects. So this slide is simply a slide that illustrates where we positioned ourselves. We then found out that in most recent times, and that's when Agnico got interested in us, that we were in the heart of the Val-d'Or mining camp with the Chimo mine project, and that we ended up being in the heart of this new major area play that is Cisco State. You can see here, this is the Windfall project, that they've got about 400,000 meters of diamond drilling in there, and I'm going to be presenting Wilson and Benoit. Why did they stake this? Well, basically, that was the last frontier in the Abitibi that was unstaked. They could not stake ground from Rouyn-Val-d'Or because that's high rent district. They could not stake ground along the Casa Berardi or the Detour because you might have seen that Darren, that's basically what we call the Balmoral trends. And so this was the last frontier. And we wound up with 2 projects that were in there. Next slide. Well, you might think that they own a monopoly there, but that's not the case. In this next slide, I simply show an illustration of what they own, the land that's in orange. And you see that there is quite a healthy competition. You can see competing juniors such as Metnor, Beaufield, Bonterra, Probe, and Kirkland Lake Gold's in there, and our properties, Wilson and Benoit, are in dark green. They've also announced that by 2020 they want to put this part of the ground into production, and they're going to build a mill in this town. This is the highway that leads to Chibougamau, and this area is full of access roads. It makes more sense for them to bring the ore from here to there than to take 400 workers from here to there. And so by virtue of that, our project has a very excellent location. What controls the mineralization in that part of the world is the fact that these east-west trending belts, greenstone belts, are cross-cut by two very old faults, and that's where the deposits cluster. So we have an advantageous position in those two belts. So without further ado, I'll start by presenting Wilson, Benoit, and I'll finish with the Chimo mine. And this is the schedule of drilling for those three projects. We're currently drilling on Wilson. By the end of the week, I think we'll have finished on the project, then we'll bring the machine to Chimo mine, and then we'll add a second machine on that, and we'll drill for the rest of the year to be able to provide a decision point for our competitors or even ourselves, and then we'll be drilling on Benoit. 50,000 meters of diamond drilling, $5.2 million budget, and we have $14 million in the bank. Wilson, right by the town of Quévillon, was discovered. Well, discoveries have been in and around there since the 1930s, but basically Free West in 1993 delineated a very smallish deposit, a historical resource of about 50,000 ounces. And then the Briec scandal happened, and it was forgotten until 2002. And then when 2002, somebody might have decided to pick it up and run with it and make it popular again. Well, Canadian Malartic, Detour, Eleanor happened, and so it really didn't get any attention. And by 2012, we acquired it 100% for $42,000. When you're on the property, this is what one branch of the deposit looks like. It's about 5 meter wide shear, it's heavily mineralized, and it's got visible gold, and it's got very interesting gold values that run up to 20 grams per ton over 5 meters, and in drilling 33 grams per ton over 3 meters. What we found out is that this type of rock here has a very unique geophysical signature, but it is also competing with parallel shears that run across the property over 800 meters wide. And so this outcrop here on this slide is that star. And we're seeing that type of rock all the way out here to the east, over 2 kilometer distance. And the reason I say it's an 800 meter wide potential corridor is that you have these 5 meter wide bands that are heavily mineralized and that can be detected by geophysics. Yet, you've got a number of them striking across, or across 800 meters. And so they're providing us with a very diffuse, broad signature. That's the bad news. The good news is that we know that we're going to have these mineralized shears over 800 meters wide, but the geophysics is not going to help us to pinpoint the targets, and we're just going to have to be drilled. We're just going to have to drill. The inset picture that you can see here, you could actually see a grain of gold, and the mineralization that's providing the geophysical signature is this stuff over here. Back up there. So we're drilling right now only on this part of the system, and we're hoping that what we learn here we'll be able to come back and apply for a much larger drill program. And so by drilling at depth here, there, right under the deposit, we've plugged 18 holes, 7,000 meters, and in doing so, we've had to back up the drills to the north, and we've recently discovered the new zones to the north. So not only have we demonstrated that we could build ounces at depth, we could build ounces laterally, but we could also build them north and south of this shear, which adds tremendous potential to the project. The Benoit project. That is actually when Agnico Eagle started to look at us. This project, again, was discovered in 1993, and from 1993 to 1997 was drilled aggressively. 72 holes, 24,000 meters, And basically what it is a stringer zone, a VMS stringer zone that grades in copper, silver, and gold. It's situated between Nyrstar's Langlois mine and the Bachelor mine right here, right in the middle, so it has access to tailings ponds and milling facilities. And this is what the deposit looks like. This is the historical estimate of about 100,000 ounces. We had no interest in re-drilling that estimate, and so we drilled 700 meters below it to basically demonstrate that the system continues. And these are the type of grades that you're getting, 5 to 6 grams over 54 meters. This is extremely wide, and it provides a geophysical signature that is unique. Not only is that geophysical unique, but we have a lot of data on this that really constrains the signature of the deposit. And in 2015, after we had done holes down here at 700 meters, there's a geophysical crew in Val d'Or that came up with a technology that can actually read down to 500 meters. Now follow me with this next slide. So here's the deposit that you saw on the previous slide. Here is the drilling that we conducted in 2014. And in hindsight, we now know that we drilled the weakest part of the anomaly. When the results came out for the geophysics, we said, well, geez, if this is a sizable deposit, then what are these things? All right? And that's what Agnico saw in 2013. And it was, for them, it was highly reminiscent of the LaRonde mining camp. If you come to our table in a while, I'll show you evidence of that. And so finally, I'd like to end with the Chimo mine. The Chimo mine is a project that we acquired from a bankruptcy sale. In 2012, when the markets tanked, we actually sent a letter out to some auditing firms, and we said, look, if you have to deal in bankruptcy filings and stuff and you want to sell some of these assets, we have $4 million, we're ready to buy them. And so in May of 2013, we got a letter inviting us to the auction process. And the auction process included a 30-day deadline, which effectively disqualified the senior mining companies from bidding on these things because they like to do 90-day audits, due diligence on environment. We had done the geological audit and environmental audit, and so we were ready to put a bid. And so our only competition were the other juniors, and so all we had to do was look at the financial statements of these juniors, which had much less cash than we did. We put in an offer, and believe it or not, we bought this past producing mine for $261,000. That's less than the price of a house in Val d'Or. Now, I want you to keep in mind as I walk through the slides that when this mine shut down in 1997, it did not shut down for lack of ore, right? The producer at the time had delineated some extra ore to be mined. It shut down in 1997 because the price of gold was at $275 US. So we've got a project that we paid $261,000, and here's the upside potential. It sits on the eastern end of the Cadillac Fault, and as you can see, production was halted at 870 meters, and yet we know there's more stuff down below it and to the lateral. And you can see the other mines on the Cadillac Fault that go down way past a kilometer. LaRonde goes down to 3 kilometers. So that's potential number one. Potential number two is that it lies just within a 50-kilometer radius of 4 other gold-producing mills and a number of other mines. So it has access to infrastructure, qualified workforce, and a place to send your ore. If we look at the project at a smaller scale, bird's eye view, you can see these squares are 100-meter squares. There's the shaft, all right? In black is the zones that have been mined out, so the gold's no longer there. In red are the zones that are actually being partially delineated, all right, or discovered for future interest. The next slide is going to be a slice through this. We're going to be looking from Eric towards here. There you go. Let me walk you through this. The original mine in the 1960s was this vein right here. They were mining very thin widths, 1 to 2 ounce material, so very rich, high-grade stuff. The mine shut down in the mid-60s, and then another company came in and mined this part up until the 80s. And as they were mining this, they were drilling to the south, and then they discovered a new vein here. So that's what we're going to call the second mine. And it basically, they sold the project to Cambior for $6 million. And what they did was they basically sold an exploration project. Cambior, which is now IM Gold, came in and mined at depth. And they explored to the south and discovered another shear. But what they discovered when they were mining at depth is that the vein actually goes from the north, the south boundary of the shear, and when it goes at depth, it just flares out in horsetails until it transfers to the northern boundary of the shear. But what is special about this project is that not only is the gold contained in these veins, but the material between the veins is not zero grade, because you go from veins to stockwork veins to disseminated ore. And that material between the veins actually runs sometimes between 1 and 3 grams per ton. And actually, Cambior, towards the end of the mine, were mining several of these veins through very wide stopes. They were reaching up to 30 and 40 meters. They were actually precursors to bulk mining underground here. So obviously, after we acquired the project, there was a whole bunch of visits from a whole bunch of senior mining companies, and they've been looking at the data. There's 4,000 drill holes, 60,000 assays on this thing, all right? And so when we took the project, we're very conservative. We were using basically a 5-gram shell or 5-gram cutoff. Our recent strategic investor, Nico Eagle, said, well, look, we're looking at this from a bulk mining perspective, because at Goldex, they're mining 1.65 grams per ton underground to a depth of 1 kilometer. So by virtue of that, we sat down with them, had a brainstorming session, and we came up with an entirely new drilling plan or exploration program for this project. So instead of drilling simply a plywood sheet, when you apply a 2-gram cutoff to this thing, it becomes sort of a huge volume. So instead of throwing a ball at a barn door, so to speak, you're actually trying to just throw the ball so it crosses the barn. So you're crossing a volume of rock, and potentially you're creating a lot more ounces. The next slide I'm going to show you is a slice through the 5B zone, and we're looking from south to north. There you go. There's the mine, there's the shaft that goes down to 920. It's currently flooded, and it could potentially be dewatered down and to re-access it. The black stuff is the ore that was mined out. The red and yellow is the ore or the reserves that the previous mining company had actually delineated before they forced the mine closure. And the second thing that they did is they explored to the east, and they discovered 2 new vein fields, one here and one here. And those were the discoveries in 1996. We drilled at Christmas, just at the time Agnico invested, and we demonstrated that these veins do continue at depth. So the exploration program this year on Chimo will be to drill 24 to 25,000 meters. There's actually going to be 44 holes, yet those 44 holes will intersect 278 separate intersections. Why? Well, because we're going to be drilling from north to south, and we're going to be sweeping multiple zones with 1 hole. So again, 44 holes will produce a stream of potential results on this thing. It is necessary for us to do aggressive drilling on this project to set it up for a decision point by the end of the year. And likewise, we'll be doing that on Wilson and Benoit. So the catalyst for you to consider Cartier is that we've embarked on an aggressive exploration program. We're going to be drilling more holes or diamond drill holes this year than we've done in the past 10 years since we've been listed. And although the delays at the labs are extremely long these days in the Abitibi, once we start to get results from Wilson, then everything should follow suit, and it's going to be basically a press release festival until the end of the year. So I hope you put us on your radar. Thank you.
Thank you very much, Philip. Got a little logistics to do here. Okay, just if you want to try to see if this one, okay, it seems to work. I'll try to do my best, but it's just that it's quite tight in this area. Oh, that's nice. Ooh. This one?
Geneva, chocolate. Yeah, Geneva.
Excellent. All right, well, I have the honor of presenting our next conferencer just before the coffee break, and we're on time. So Peter Berdosco, CEO of Guyana Gold Strike. So we're going to leave the Abitibi and go down to the Guyana Shield, which is also very very well endowed gold area. Peter is a veteran, I would say, of marketing. I didn't bring my notes, but I just want to highlight that effectively I'm starting to have confidence in this guy in terms of able to deliver. And so this is, for me, a new story, but an interesting one. And so, Peter, come and do your show.
Thank you. Where's the clicker?
Clicker's over here, green light.
Green. Okay. To the pointer.
Yeah,
there?
exactly.
I'll take that. Thank you, Eric. I'm going to walk around a bit, so we can do this. Guyana Gold Strike is a new company. We closed the transaction in March. This was a shell public company that didn't have any operations. We took it over and we vended in a new project in Guyana, changed the name, restructured the company, and now we're launching and coming out and just sharing who we are and what we do as a company. What I like about Guyana Gold Strike is we've got elements of exploration in terms of blue sky, and from an investment perspective, it doesn't change why someone wants to put money into an exploration project. Your ability to take advantage of that blue sky and have very good returns is there. That never goes away. However, as you know, a lot of times when we do think we're doing a smart investment, it doesn't end up going that way, and we end up losing on the wrong side of the bet with exploration. So in putting together Guyana Gold Strike, I was cognizant of this, and this project came along, and we thought this is something we wanted to be involved in. And that's why we start with our slogan of being a gold producer and advanced explorer. So we have the best of both worlds. We have the blue sky of exploration, but we have the sensibility and minimized risk, if you will, of having an asset that's already in place. Because this project actually has some history, and then we'll go into that in a second. But to even maybe be more frank or clearer with you, and I was asked to do this from yesterday's presentation in Zurich. Manuel actually came up to me and said, "Excellent job, Pete," but he says, "Be even more upfront at the beginning and let them know why you should invest in this company." So I changed one of the slides. So reasons to invest in Guyana Gold Strike. This project is a permitted mine. So on day one, we have a permitted mine. So there's no issue in terms of us having to go through the hoops and getting a mine permitted and the time that takes and the expense and any hurdles we may run across or come across. We have a permitted mine that comes with this project. We have 100% of the project. We already have our first sales, and that's something nice as a junior to hang our hat on. The sales, the numbers are not large, and it's from alluvial. But that's not really the focus. The focus is that because of the mining license, we have an ability to have some sales. And to on day one, to be able to report sales for a junior company just doesn't happen very often. And I received calls after this news release went out last week, actually. And I had individuals, associates saying, wow, I can't think of any other junior as quickly as you guys have, or any other junior really that has an ability to speak to sales or to revenue to some degree. So that's nice, and I think we're doing the right thing. We have a very good share structure, 29 million shares out, which gives us a current market capitalization of $9 million as we trade in the 30-cent range, about 32 cents. Historically, from prior operators, there's 880,000 ounces of hard rock gold on the property that's been delineated. And that's from $30 million US that's been spent on the property, 42,000 meters of diamond drilling. 760,000 of those ounces are at 5 grams. So the economics potentially are very, very good. 5 grams is definitely better than 1. With our $9 million market cap, the market is giving us a valuation of $10 an ounce for our historic ounces. So what does that mean in terms from an investment perspective, if you're looking to invest in the company? Well, today, the resource market looks like it's going in the right direction, and gold's hopefully looks like it's going in the right direction. We should have some continued upside. That $10 an ounce, if we do our job right and the market does its job and continues to appreciate, gold price goes higher, that should turn into $100 per ounce. So there's good upside there. So again, from day one, we've set ourselves up with a strong foundation to take advantage of a strong market moving forward. We financed the company with the close of the transaction, $1.7 million. That's good to know. And I think what could be argued as being one of the most important factors with the success of any junior is that we have an experienced management team with over combined 120 years of experience in managing resource companies, technical work, geological work. And the next slide will speak to a little bit of that. That's me at the top, Locke Goldsmith, senior geologist with a lot of experience. He first walked this property in the early 90s. He was exposed to this property. He was part of the work that the last operator did in 2011, 2012. So he knows the project intimately. He's able to speak to it technically at depth way more than I ever could, or way more than I ever would want to. So you'll find from my presentations I don't get too technical. If you want the technical stuff, you can always go to our website, or at some point, a presentation by our geologist would definitely fulfill that desire from you. But he's excellent, and he's going to oversee our exploration and our work on the property. Marshall Mintz, when you're looking at being successful in another country, it's key to have individuals on the ground that understand the government, understand the politics, understand what's needed to be successful in that area. And so Marshall here has had experience. He actually does business. He's done 14, 15 years of business in Guyana. He lives in Guyana. Is absolute paramount and key to our success. We could not move confidently or successfully in this country without having someone like Marshall on the ground there, knowing how to do business and making sure that everything is overseen and run properly. That is absolutely key. Independent Technical Director Don Byrak, another key member. He was Prospector of the Year a few years ago, Co-Prospector of the Year. Very seasoned from a directorship, VP of Exploration standpoint. So a very good team. Okay, Guyana. So South America, not to be confused with Ghana, Africa. This is South America. Key points to this: English-speaking, British common law, democratically elected, very established mining act, and a history of gold production. And very important that it has the Guyana Shield. That's not a misspell. It's spelled that way with the I. And the Guyana Shield currently has 110 million, just over 110 million in gold inventory. The Shield is very underexplored. Generally, people are familiar with West Africa and the success of exploration and mining in West Africa. There's about 275 million ounces currently in the inventory in West Africa, are being mined. And if you will, Guyana Shield is sort of like the sister to that geological area. There's geological continuity. So when we go way back millions and millions of years, the continents were together, they moved apart, and so you have this continuity geologically between the two. And the Guyana Shield is very, very rich, very endowed with gold and other elements as well, and definitely underexplored. So again, we were excited about this because this presented an opportunity for us to take advantage of an underexplored area. This is maybe the up-and-coming premier exploration area, one of them in the world. Here's the Guyana Shield to give you an example. So there's definitely some prominent or notable mines, deposits. You have some of them are north of 10 million ounces, 17 million ounces, 13 million, 9 million ounces. Really, really good endowed properties and mines. And you see all the black dots there, those are minor deposits. So some of those are locally mined or just mined privately. And we've broken this up into a north belt and a south belt. And we're down at the south belt there, and we feel that as well we're on a sort of leading edge in terms of exploration in the south belt. And this will give us a lot of opportunity to gain additional properties and exposure in that area. So it's kind of nice to get a little bit of a standalone there. The main peer, the main company that would be the poster boy or akin to mining in Guyana is Guyana Goldfields. And they're just shy of $1 billion company right now. They are mining. We basically are modeling ourselves after them. They mine the hard rock and they also mine saprolite. And for those of you that aren't familiar with saprolite, saprolite basically is the weathered, soft, broken down rock that you find at surface that goes down to about 40 or 60 meters. And it provides nice credits to mining. It's accessible. You need to strip it away to get down to the hard rock anyways, so it makes a lot of sense to mine it. So our strategy would be the same. The recoveries are very good. In fact, the recoveries for Guyana Goldfields is 97%. They get better recovery from the saprolite than they do from the hard rock. So that's going to be our model too. You'll see in the next slides as well. We're going to do that model. So I've already talked about the Guyana Shield. Very underexplored. Continuity with West Africa. There's the Aurora deposit, Guyana Goldfields that I just mentioned, that's in production. Just under 3 grams, 2.8 million ounces, 188,000 per annum. Their sustaining costs, very good, $600. Generally, everything falls in around $600-700 US for your all-in sustaining costs. And Karuni deposit is Troy Resources. Troy Resources trades on the Australian market. So the Marudi project. So again, we purchased 100% of the project. We have a 2 million ounce potential. So the 2 main development sites that make up the 880,000 ounces that we have, they are both open at depth. The one pit design with the one deposit site only went down 200 meters. So by going down to 200 or 250, 300 meters, we feel very confident because it's open that we'll be able to double our ounces by doing that. It's also open to the west. And the other site is open at depth as well and open to the east. So we feel very confident that we'll be able to increase our ounces close to 1.52 million ounces on the hard rock. I already mentioned over 3 million, 42,000 meters past operators have done. We have the first gold production. Our strategy as we move into the second half of the year is to commence the gold and saprolite bulk sampling. So to continue to generate more revenue from the mining of the bulk sampling of the gold that's in the saprolite. We don't know anything about the saprolite. There's very little done historically by prior operators. We believe that it's reasonable to suggest there's 3, maybe 500,000 ounces. The local miners definitely mine a little bit of it. And so we know the sweet spots, we know the areas. And so we're in a position where we can take advantage of that. And we'll also start to do technical work to define how many ounces there are and sort of plan our map as we move forward with that mining. Just one really quick thing to know regarding the mining license. It was grandfathered in. They changed a few years ago to an 8% royalty. We're grandfathered in under a 5% royalty. So that's a nice little bonus for us. So every time that we sell our gold, it would be 5% rather than the 8% that goes to the government. So there you can see the mining camp, established mining camp. Those are the core shacks that you're looking at from the previous diamond drilling that was done. Now, a question came up yesterday was, well, you're to the south, what's access like? Is that going to be a problem? Not at all. The prior operator had begun to sketch in a airstrip, and we're now permitting to complete that airstrip. So $50,000, $75,000 completes the airstrip. And so you're in a situation where the dory bars will be actually done on site and then flown out from our property right to Georgetown and sold to the guy in a gold board. So very simple process, really low security risk, very streamlined. And so for investors, you want to know that, technically how do you get the gold out is it a challenge? So no, it's not going to be a challenge at all. Very good infrastructure. So this was again the news release that we put out last week. So the artisanal miners, these are local miners, they basically mine $1 million, 900 ounces from these streams, the streams within our property. As a public company, our interest really isn't the alluvial. There's not enough upside for us in the alluvial, and in terms of technically, it's hard to define what you have in your alluvial. The nature of it makes it that way. So to have a number of the locals there able to make a living and mine it, and for us to charge them a 10% royalty it makes good sense for us. There's very little supervision that we need to put into place, and they're working in an area that we're not going to focus in on. So that was smart for us to do that. I should add that we have what we call a gold room. So basically it's a shaker table that's going to be on the property in the next couple of weeks. And so we're going to give them access. We're supervising it. Sorry, they'll bring their concentrates, and then the shaker table actually will give them a better recovery on their gold. Right now they're getting like 15% recovery, which is terrible. So with the shaker table, that should definitely go up closer to 30 or 50%. And so because we're doing that, we may be in a position, we're thinking about potentially increasing our royalty that we pull from them because they're using our room there to do that. So that's a nice thing. So that was first sales, 100,000 US. So again, basically a new company and able to talk about exploration, able to talk about resources, but more importantly, able to talk about sales and revenue. The gold and the saprolite is our focus in terms of revenue and sale production, and because we believe there's a substantial amount of it there. So the 6 to 9 months moving forward here, we're focused on the logistics, the testing, preliminary sampling, the mapping, geophysics, and putting together and seeing what that looks like, and then we'll look to streamline the process, and we'll start with a low throughput, and then we'll look to increase that throughput. We want to prove profitability. We want to see what the cash flow looks like, and just get the mechanics working properly and all that. So that'll take 6 to 9 months, but there'll be a little bit of revenue that'll come from that as well, and hopefully we get it to a robust stage where there'll be some decent revenue or credit, if you will, that will come from that. It's almost a built-in financing. Can you imagine? We don't need to go to the market potentially to finance. We're going to finance off of revenue. And so for a shareholder, maybe potentially thinking about investing, we have 30 million shares out, there's a little bit of sense of comfort that we're not going to have 300 million shares out. I'm not saying that we're not going to go to the market, we'll do questions at the end, but maybe write it down if you have. So I'm not saying we won't go to the market, but that to have revenue is nice. Obviously, I don't have to explain that, everyone gets that. But it's not, for junior companies, it doesn't happen very often. These are the two main development sites that I was mentioning. So you have Maruti to the north, and then you have Mazoa Hill to the south here. Mazoa Hill is definitely an open pit. They went down 100 meters on it. We can double that. And Maruti North has a lot of exploration. Now, if you can see these red lines here, these are trenching. This is trenching that was done in 2011, 2012. They were getting gold values from all this trenching here. In fact, Locke believes that there's a connection here in mineralization from Mazoa Hill to Trench F here as well. There's a lot of exploration left on this property. And so I almost like to call it soft exploration. We know where the areas are, we know where we're going to focus in on, and we believe that's where we're going to get our value in additional ounces. Here's an example, I can't remember which trench I put up. It looks like trench D, I think. But some real good values here from one of the trenches. So Mazoa Hill, that went to the south, just a little bit more information on it. There was a 43-101 done on this, 96. So we're very confident with the historic legacy data that we received, and there's an amazing amount of data that we're actually sifting through. And our presentations will get a little bit more technical as we start to sift through it and put the data together. This was the resource estimate in 2004 for the 5 grams. There's the cutoffs and the counts. Here's some of the drilling that was done off of Mazoa. So you can see these numbers are very similar to, if you're familiar with West Africa, these numbers are very similar to West Africa. You're getting 14.8 over 6 meters, 1.8 over 33, 13 over 1, 3.7 over 25 meters, 5.8 over 11, 1.7 over 41. Really good numbers. Very, very good numbers. Some real good high grade and some good runs. And the depth, this is key as well. We should highlight this. I should highlight this. Is 60 meters, 100 meters, 140 meters, 80 meters. This is really shallow as well. Very shallow. This is the area to the north. This is not including the trenches. This was just the main area that you saw in the box, 500, 500 meters. It's about 100 meters from the main camp. The grade's a little bit lower here. It's 2.7, but that's still very good grade. That's just a picture of some of the cross-section of some of the drilling. And this is some of the exploration upside. So again, Maruti North, the extension to the west, it's open. Maruti Ridge, that's the trench F that I was speaking to, and Kimberley Ridge as well. So we'll be focused in on those areas. Our strategy in terms of the hard rock is to, for now, just leave alone the historic and work on building the ounces, the soft exploration and building the ounces. The market will give us value for that. The market's not necessarily going to give us value for auditing the historic. We're confident it's there, and we'll bring it all into a resource estimate at some point, but let's build on the ounces because the market will give us points for that, and that just bodes well for our market cap and our ability just to move forward. 18 months then. So again, 2 million ounces. Work on getting to 2 million ounce compliant resource or more. Establish the baselines on the saprolite, profitability, revenue, cash flow. Hopefully prove out that we got 500,000 ounces or more there. And then looking at the 24 month stage, then we're looking at more of a formal, robust bulk sampling and hard rock PEA. Again, our numbers, just under 30 million out, 32-cent range, $9 million market cap. Current valuation on our ounces is $10 an ounce. Pretty cheap. Here's a comparison to our peers. Guyana Goldfields, I mentioned earlier, they're the big boy in the block, just under $1 billion, trades at $560. Troy Resources, Australian company, 7 cents, but $35 million market cap, Australian dollars. Sand Springs, a Canadian company, $37 million Canadian market cap, trades in the 40 cent, just below 40 cents. Notice their grade, 1 gram average. They have a lot of it, but it's 1 gram, so it's not really, so our grade is very good. Gold Source Mines, 12 cents, $21 million market cap, and then Alicanto. Alicanto is pure exploration funded by Barrick. And it's nice to know that Barrick has some interest in the area. So Guyana Gold Strike, there we are, 32.5 cents, $9 million market cap. So post-transaction, post-financing, we feel we're very attractively placed in the marketplace from an investment standpoint. So just to recap, again, to close it off really strong, why Guyana Gold Strike, why an interest, why potentially looking at it for investment? So great starting point with the historic 880,000 ounces, 760,000 being at 5 grams. And a clear strategy to develop that within the Guyana Gold Shield and get that to 2 million ounces with what we have in terms of exploration on the property. Permitted mining license with the ability to double our ounces going below the 100 meters. We already have sales, and we're going to continue with sales and revenue as we begin on our saprolite bulk sampling. Very attractive share structure, very well placed in the marketplace at $9 million market cap. Very cheap ounces in the ground that should appreciate as gold continues to appreciate and the market gets stronger. And again, a very experienced management team with a lot of years of combined mining and resource experience. Thank you very much.
I'll just give you a good handshake, sir. We probably have time for a quick question if anybody's interested, but it is the coffee break, and je voudrais vous remercier, mesdames et messieurs, pour votre attention ce matin. I want to thank you for your attention, and so it is the coffee break. We'll reconvene in about 25 minutes. Does that sound good? Excellent. Hey, good presentation.
Better than yesterday?
Look at I've got so much stuff in my head.
Okay, but it was good.
It was good.
All right.
I would say it was about the same. I think the idea of coming right strong in the beginning is
Yeah, it's good, yeah.
but it's not bad either to build up a crescendo.
Yeah, see,
So
everybody's got that.
exactly. So what is the best recipe? I don't know.
I don't know. I don't mind doing the over because I think sometimes they need to hear it 2 or 3 times. So you're saying it the first time, then you're going through the details, and then you reinforce it at the end.
My only little comment would be, and I know you don't have all the technical, but
Add
some of
more.
the maps.
Yeah, I know. We're
you
just not there. I know.
Exactly.
Yeah.
Now,
We're getting the
what I would
base.
suggest was sometimes I have to oversimplify. And so, yes, some of these maps will make it very, very simple. And, that south belt, north belt. And then in terms of trenching, just really, what I'm saying, dumb it down.
Oh.
Because that's what you want to really basically do.
You mean there's too much on those maps? Is that what
Oh,
you-
yeah.
The maps are too complicated?
Yeah, I can't even read from where I was.
Oh, really?
You understand what I'm saying?
Oh,
Now, I understand there's a balance between putting the correct data with the correct location and the
Yeah.
correct intensity of work.
Yeah, and then you don't want 3 maps saying what 1 map can do, right? Because then you stretch out your presentation, right?
But what you really want to show there is look at, there's been work, there are some trends, and voila, the amount of work that's been done, but look at what's open in terms of potential and at the different property level at the district scale.
Yeah.
But I mean, look at it, again, there's no perfect recipe how do you represent it, but I mean, I think my main comment was basically, the maps, I couldn't really see anything.
Okay.
But as a geologist, I know it's important. I am the devil, and the devil's in the details. I want that information. But I think for the crowd, the one I think is it this one?
Yeah, I just did that because it's a technical one that we had.
Jason Meisner's.
Maybe that one.
I think it was really this one.
Oh, okay. I don't even know how to do it.
Well, I don't even know if it's a map or a section.
No, it's a
or-
section.
It's toujours à TV.
It's a cross
Are
section.
we still on TV? Phew. Because he doesn't
Oh,
want
the live stream.
Yeah. No, but that was on.
Yeah. No, it's okay because I told Manuel I didn't want this streamed anyways. So were you streaming it? Because I told him yesterday. It doesn't matter.
Ce que j'ai-
Is it stream? Was it streaming live? Oh. Well, was I supposed to tell him not to stream it then? Oh, you can't? Oh, but I had to tell you first.
I think, what is done is done. It's like a
Yeah,
shotgun, it's been
whatever.
shot. Mais probablement, ce qu'on va demander, c'est que quand ça va
But
aller
it's
sur
already
YouTube,
on? It's already on the internet? Yeah.
It was live streaming. What I'm saying exactly, it's like a shotgun. It's been
Yeah,
shot.
yeah, yeah.
What we'll do is it won't be on the website. It won't be on a historical
Yeah,
record.
okay.
Okay. Mais on
So I
pensait que
didn't
ça avait
even
été
think
fait.
about
c'est ça.
that. I didn't even think about that. So I'll know for next time.
I thought it was Ben, but I just learned just before he's talked that he wasn't going to be live streaming, so I didn't have a chance to tell you.
Yeah.
But there's another one. It was Ben. It's another one. Exactement.
Sorry, it was my fault. I should have went up to
No,
you.
you didn't make a mistake. It's just this was a change of state.
Yeah.
But I think Manu should have advised.
Yeah, he's got so much on his head, though, right?
Yeah.
In his head. Yes. Yeah. But I was thinking that I wasn't, so that's why I thought it was okay to move. Yeah, that's why.
But look, I think in terms of your presentation, I think it's good to be different. I think it was good to walk around. So I think it's this mixture that makes it fun for everybody, and you get more of the attention of the crowd.
Yeah. It's a little bit more personal when you're down there. If there's a little bit more of a connection that you feel with the audience, right?
Ouais. Pour le reste, ça a bien été. Excellent. J'espère que non. Mais je vais m'informer, mais je pense qu'effectivement, le prochain... yesterday, Jurg, he moved about, and we have that. I'll go and ask. Je vais aller demander si le prochain conférencier, s'il a l'intention de bouger, puis on lui donnera les directives, parce qu'on a le temps, là. Exactement. Exactement.
OK.
L'Amérique. L'Amérique. Médéric. I'm notorious to... It's terrible. I'm getting old and I'm losing it.
No worries. Anyways, that's fine. It's gone. So the stream's done.
The stream is done.
Whatever's on there. And nobody in North America's up now anyway.
No.
So no big deal.
Except
So
some
my
are.
fear is because of Nexus. I don't want someone starting to badmouth. What the fuck is this guy doing with Guyana? And I'm a shareholder in Nexus. So I'm a little bit sensitive right now, right? Until, you know.
But you have an intention to continue with Nexus, or?
Oh,
Yes. Okay.
It's actually like a lot of stuff on my plate. I'm the guy who, you know, I can 2 or 3 girls in bed, no problem.
You're the man. You're the man to be.
It's Manuel today.
I know.
He's crazy. What his friend? What's his friend? The accountant. I'm talking.
You this morning?
Yeah, and he went to visit him. He says, Manuel's trying to pass me the crazy. Look at Manuel. You're an animal. Me? No problem.
think it's gonna work. Ménéric, I got your name right, huh? He might want to move. Fait que c'est quoi la recommandation?
Yeah, so they live as the logo, right? That's the local market.
I think so.
The
Yours, try it again.
Yeah, now we're in the process now.
Yeah,
Now
perfect.
establishing that 6 month baseline. So it'll be a little bit reduction. Il veut bouger c'est purement conseillé. But if you move, you will have to fill the rooms with the commerce. It's not actually on property yet, so it's going to be complicated for you. It's possible, so you can move on multiple.
with two leading Swiss banks, Crédit Suisse et Union Bancaire Privée. He's going to present us Asia Pacific and its opportunities in the resource markets. George,
Thank
floor
you
is
very
yours.
much, Eric.
You're welcome.
So as you can see, I've got the golden cock up there. It's the golden rooster, still in China, and the golden is a golden opportunity. And what I'm going to talk a bit is about the Marshall Plan of the 21st century, which is quite essential. The impact of what it's going to have in the resources space and where the opportunities are from a value perspective. So if you look at values, I've got here a chart, 5 companies. And what I would like you to look is particularly where are your spreads, your return on equity, assets, capital, where are basically your dividends, your growth and dividend payouts in that area. And I just would really quite quietly do a test to see what you think these companies are. So if you look at the number one company here, who believes that's a resources company? Nobody, okay? Number 2, very similar margins as you can see, a little bit more debt, P slightly higher, dividend yield, okay-ish. Resources company, no resources company?
I'm going to lift my hand just to start there.
Resource company, thank you. A couple of bits. Number 3 here, what you think? Decent yield, 6.2%, great margins, resource company, no resource company? Resource company, 1 bit, 2 bits. Okay, thank you. Number 4, similar question, hands up for a resource company. 1 bit, 2 bits. Okay, it's really a low margin business here, 2 out of how many? And the 5th company? All. Well, not quite, but we'll see a bit later. Well, let's keep on. So I'm talking a bit of Silk Road. I think everybody knows that we're spending roughly $1 trillion as China to basically build this large empire. And with this large empire, China has actually started concentrating on the offtake of high quality materials, but as well on monetary aggregates. And if you actually look here, basically since 2008, where we start to print money like hell, China's been buying up, together with India, all the gold production of the world and whatever has been spare on top of it. On top of it, we've been creating the Shanghai Gold Exchange, starting 1st of July, the Hong Kong Gold Exchange. We're establishing right now a Petro One structure, which is going to change actually the currency mechanism and the pricing mechanism of commodities. And what we see as well, that we have already scarcity emergence with premium being paid for good quality assets and production. So if you look at Asia, it's a huge area. You see many, many countries, but one of the key problems we have, like everywhere, is the asset really in the right country? Do we have a mining code? Do we have sustainable environmental? How's the patronage system working, like in Malaysia, where you have your Bumi participation? Taxes, royalties, it's like Vietnam, where your royalty can go up from 1.5% to 21%. And what's the social contract? And I think everybody talks about that in Asia, but Asia is very complicated. I think for people who just look from the outside, I think it's an impossible task. It's not impossible, but it just needs much more work. So experience helps. So just to quickly come back to the Silk Road mechanism, which actually is supporting this PMI growth. So people will not have to worry about the demand collapse of commodities as such. If you look here basically of the contribution and responsibility of China's in the resources sector, you actually start seeing that the numbers are actually looking frightening. If you look at the total amount of offtake they're taking on, you actually wonder where the rest of the world is actually participating in this trade. I don't know why people read the Wall Street Journal and ask what Wall Street is doing in the United States if you see these numbers. So what are we really worried about? We're not really worried about demand, we are worried about supply. And if you look at this chart, in short, it's actually the copper market, and you look at the grades in the copper market, and what we expect by 2023, we'll expect a 20% reduction in grades, and therefore a 20% reduction in output. in an environment where Asia Pacific is growing. The same chart here is the zinc market, and you see again you see a 20% contraction in that. What's important for the zinc market is very well important for the lead market and the silver market, as a lot of these assets are basically combined products. So let's quickly compare the China versus the United States activities. And if you actually look at that, it looks like the United States has a lot of gold and China has not, but I just showed you the imported tons and tons, probably 30,000 tons of gold. And in the case of China, it's not all owned by the central bank. We've got 4 commercial banks which are fully owned by the national bank, which are actually hoarding on their behalf. So getting the true number is probably not quite realistic right now. What we see, the United States is exporting everything they have and more, 350 tons a year, whilst the imports in China go the other way around. If you look at the trading mechanism, you see actually that we have very different delivery on the exchanges. But if you look at the paper contracts here, you see a very clear winner, United States. So the leverage here between the physical part and your paper markets is astronomical, and this mechanism right now is actually fixing the price until that mechanism will take over and refix the price. You already see in some other areas where actually China is very dominating, so you can't really be in the solar business without basically the Chinese, and you will not be in the battery market very much longer without the Chinese. The new graphene batteries will have 10 times more capacity, they load 10 times faster and are half the weight. But China is controlling basically the supply. Everybody knows we have small premiums in China, so I think they will continue. And if you look now at financialization of assets, you actually start seeing what it really means, what I said in the gold space and the trading. The numbers have gone ballistic, and basically what we have here is actually just paper contracts. Paper contracts fixing the price at no added value. Outside trade contracts in the gold space are paying now double-digit returns, and if you look at the forward curve in gold, like Aussie gold, let's say 1700 spot Aussie, the forward rate in 2 years is 1870. So it tells you we have actually a problem in this financialization system. That's the LBMA market, and you can see what the inventories are and what's on the end left on the delivery side. It's basically nothing. You see this huge volume here, and basically you're lucky if you get 40 tons, probably closer to 14 tons a month, which is available for delivery. So the market is getting a little bit jittery on that, and that's the Central Fund of Canada. And what's interesting, the fund has now a 6.5% discount to the NAV. Why would you have an environment where people tell you have shortages, a discount develop in a financial instrument? And basically people will question here the underlying. So let's just quickly look at India. February I was in India, it was rather hard. You remember me of Italy in the 1970s. We went shopping and you got basically sweets back. Here they gave the money and in return you got nothing. And that meant actually that even the Indians don't trust the government, that they're accumulating at record speed. This year, imports after the monetization in India actually doubled. So let's quickly look at the Australian gold mining market. I think everybody here is very North American focused. If you actually look at here, the largest producer is China. Number 2, Australia, producing twice the amount of Canada. So we're producing twice as much, but hardly anybody is looking at it. Australia only represents roughly 40% of the global world mining index. It's actually amazing. So let's quickly look what happens to money. And it's actually amazing. Everybody knows emerging markets are under pressure, and you see gold since 2000 in Malaysia has 6-folded, in India 6.5, Brazil and Nigeria they stand out, so I wouldn't really want to live there. This one is much more interesting, which a lot of people will be surprised about. That's Great Britain. It looks actually very similar to India. You wonder who's the colony. But then, not everybody lives in India, and not everybody lives in the UK, but the title is Not Everybody Lives in Switzerland. Everybody thinks, Jörg, there's no inflation, what are you talking about? It looks quite modest, but even here you see actually momentum's turning, moving average is turning up. So let's look at the Australian gold mine space, because that's where we think the opportunity is. That's where the profit margins are the highest today. If you actually look at here, we are turning up, we are turning up. We are here roughly at about 1,700 Australian dollars. That's basically the mining index in Australia, and you can see we retracted all the way back to incredible levels. The momentums are turning as peak capex is gone, production slowdown is going to come. Valuations are basically turning back here in the sector. So where do we really see that the opportunities are? I think we still like high margin business because the credit is quite questionable. The volatility in the market is quite questionable. We like volatility writing where assets are expensive and they are paying up to 25 to 40% analyzed premiums, which means my entry level into the market to accumulate key assets is actually quite generous. And what we really like is companies which have a chance to be rediscovered and re-rated due to valuation gaps. So basically we are in the segment, I think everybody of you has already seen this picture, where the development comes in, but you can be a producer and add new development, so your risk is actually lower and the rediscovery and re-rating benefits is actually quite big. So this space here is probably the most interesting space, but to be true and honest, I can't find more than 15 companies in the world which are really in that field. Sorry, there's a small little mistake on that here on the debt side. I think I mixed here the two sides up. So what you actually see on both of that, Australia and North America are both basically valued about 1.2 NPV, which is in history terms quite cheap, particularly in the bull market. This number will go rather up to about 2.5 to 3 times. Where the big difference is we have shorter mine life in Australia versus the United States, which is a negative. But what we have, we are much more conservative in using higher discount rates than in Canada. And as a result, what we actually have is higher profit margin. So in an environment where we have zero debt, basically, and higher profit margin and trading in lower PEs, which is almost half of what we have on this side, we have actually a valuation gap which is wider than an 8-year line highway. So let's look quickly at this valuation metrics. And what you have here is return on invested capital on equity, corporate overheads, and basically general returns. What you see that our top 6 Australian names are all in this side. That's the rest of the world. So let's look at it from a different point of view, and that's basically capital intensity ratio, and you have exactly the same. The 6 top names in Australia sitting on the bottom of the curve here, and then you go way up all the way. So what we really like to do, the first issue what we do is we're actually concentrating on management. How is management exposed to it? How much do we own of a company? I think out of the 3 companies, which you're going to see later, all the 3 companies have between a 4 and 11% representation on management on the equity side. For a producer, that's quite really rare. We're looking that we have added growth, value, and in general, coming back to the return metrics is for us, that's pretty key. If you can have a return on equity of 25 to 35%, I get my money back every 3.5 years. So what are we doing in Swiss Asia Capital? We are actually an open platform. We are selling know-how, and we've done a few things. We've done an Australian certificate, which is basically a dividend yield structure, but we set it up in a way where we get full franking credit. The portfolio has a 4.2% yield, and despite having started in 2012, it has a positive return. We then started in about a year ago an option writing structure where you could actually write options on Kirkland Lake at half price to book, and getting 40% put option yield return. So basically you bought the stock at 0.3. So we have quite aggressive option writer. So in other words, we are cash hungry, we are cash bucks. People call us all normally gold bucks, but I'm a cash buck. I like cash flow. So that's basically the products we have, and we normally tailor make them to client needs. So the first one was designed by us, which includes all the strategies, and then we have a lot of individual strategy structures. So let's come back to the quiz, and let's quickly look what they really are. So everybody knows this sign, right? The Swiss National Bank almost owns that company. Debt to equity 27%, 47% debt to asset 27%. Growth actually 0. EPS growth is going up. Return here very similar to the mining companies. That's Kirkland Lake. 50% of the assets are in Australia. The other are in Canada. Returns are pretty much about in line with the better companies in Canada. And you would expect that if they basically trade at twice the valuation. And then you start looking at these companies here. Shorter mine life, but look at that. Still 30% growth fully funded. And you still throw $700 cash out on a 1,700 gold price in Australian dollar. So each of these three companies last year generated $200 million net cash, which is a multiple of what Agnico Eagle was producing last year. So we certainly have valuations in here which are extraordinary. And how did they really achieve that? I think this company here bought 400,000 ounce production from Barrick for $75 million. Barrick kept the debt. In the meantime, the mine life of these assets which were bought were increased by 50%. The cost structure was reduced by 30%. And there are two other features. If you have about a 25% debt level in your company, your debt cost as a mining company is about $100 an ounce. So your first $100 already gone. So they bought this asset at $75 million. The replacement value was about $250 million. So the amortization of the capital cost in general, if you look at most mines companies, about $100 an ounce. So it's another $100 gone. So your margin is already $200 without having done anything. This $200 allows you now the flexibility to grow a company and return shareholder values. This company here really struggled all the way down. They had $350 million debt 2 years ago. Today they are $50 million cash. So they created $400 million net cash. By next year we're going to start paying dividends. So what you're going to get when you are actually successful converting business activities, that's what you're going to get. High dividend structure, you still have growth, and it gives you flexibility. So the next downturn, when something comes, my bet is that all these three companies will buy on the cheap. So as we say as an investor, buy low, sell high. It's a good advice. You get well supported, and you're getting paid to wait. Everybody uses a gold buck or resources buck because they see the longer picture. We don't know what the price is going to do, but in case we go 3 years sideways still, I'm very happy to sit in here because within 3 years I will have double my money. So to come back full circle, Australia, second largest gold producer. It's not a surprise that the largest nugget ever found was in Australia. So if you have any more questions, you can always come back and see me or my colleague Amelin, who sits here as well in this room. Thanks very much for your patience and attention. And
thank you very much, Bert, for the great presentation. You could just turn off the your. Yeah, turn off right away. Excellent. Oh, did I turn it off or did I turn it on? Okay. Yeah, thank you very much for that great insight. And thank you very much for the time. So we're going to go and focus effectively right now into Australia. I have the honor of presenting Mr. Michael Dunbar, who's Managing Director of Gascoyne Resource Limited. Looks okay. Michael is a geologist with over 25 years of experience. A lot of stuff. He's worked in different types of geological environments for gold, nickel, and in different types of, like I said, environments. Companies such as Eagle Mining, Lion Ore, which is now Norilsk Nickel, the Mitchell River groups of companies, Albadan, Maribela Nickel, African Energy, Sally Malay Mining. And so, Michael,
thank you.
The floor is yours. Move forward. Yep. And the point over here.
Right. Fantastic. Thank you very much for that introduction, and thank you for the organisers for the opportunity to come here and present to you all today. So it's great to be here. I'd also like to thank Jörg. I think he's given a perfect segue into Gascoyne Resources and what we are. We are the only Australian company here, high margin gold focused company with assets in Western Australia, low risk jurisdiction in Western Australia. I probably should steal a few slides from Jörg to throw into my presentation. I will be making some forward-looking statements, required to put this up for ASX disclosure reasons. We will. This will be on the website shortly. So we are a Western Australian focused company with 2 + 1 million ounce ore bodies on granted mining leases in the low risk jurisdiction of Western Australia. The first asset we'll develop, and we are developing right now, is the Dalgaranga Gold Project in Western Australia, in the Murchison of Western Australia. We finished the feasibility study there on that asset in November of last year, and we've constantly improved that asset after feasibility from then until now, and we've grown the resource by over 17% since we completed the feasibility study. The production profile has increased for the first 2 years from 100,000, 105,000 ounces per annum up towards, and in fact in excess of 120,000 ounces for the first few years. All at a low capital cost and high margin. That is an advantage that Australian companies have got over most of the other gold companies in the world, in that our costs in Australian dollar terms, all-in sustaining costs, around 930 from our feasibility study, but for round numbers use $950 an ounce. Today, $1,700 gold price, that gives us a margin of approximately $700 to $750 an ounce. Now that is an outstanding margin in any business. That really then lets us leverage off that and off the low capital cost of that asset to build our second asset, which is the Glenburgh Gold Project, another 1 million ounce gold project, also in Western Australia. And it's hard to believe that 2 + 1 million ounce ore bodies with higher than average grade for undeveloped assets in the world can be found in the low risk jurisdiction of Western Australia. We are an exploration company and will continue to explore those assets and see further growth of the assets going forward. So I'll focus mainly on the Dalgaranga project. That is the one we're building right now, but I will very quickly at the end mention the Glenburgh project. So Dalgaranga itself is in the Murchison of Western Australia. It's just outside, 60 kilometres outside the mining town of Mount Magnet. They've been mining gold there for over 100 years. And we control around 85 to 90% of the entire greenstone belt, the Dalgaranga greenstone belt. A unique position to be in. Granted mining leases, granted for 21 years, with a further extension for another 21 years after that, and we're about 2 years into that life. No environmental issues, very good metallurgical recovery and reserves currently of 580,000 ounces. In the mine plan we have 620,000 ounces so far, which gives us a 6-year life with clear extensions beyond that. So the path forward and where we are right now. As I mentioned, we finished the feasibility study in November of last year. Since then, we've split the company, if you like, in two, all under the same structure, but an exploration arm to allow them to continue to explore and grow the company. And then the project development arm. By doing that, we allow the exploration team to continue to focus on exploration, which is the lifeblood of our business, and will continue to show more growth and more mine life growth going forward. That exploration team has already had success. We announced a discovery in March of this year, modest in size, the Sly Fox discovery. That's already will be paying dividends into the project itself, and now is being incorporated into the optimisation and the implementation of the asset. Moving forward towards production in Q2 of next year, and first gold in Q2 next year. So I'll really focus on what our main activities are right now and how we're moving the company forward. A very quick timeline of where we're at. You can see I'm here alone because the rest of the team has to constantly be kept busy with all of the project optimisation, financing discussions, development decisions, and all long lead time items. Right now is one of the busiest times in terms of activities, both on site and with the project. Construction is happening right now and will be, as I mentioned, production next year. So the project itself, it's all on the one granted mining lease, and there are two open pit mines, open pit mining only. The first that we'll mine, and they're within 3.5 kilometres of each other, is the slightly higher grade Golden Wings deposit. We'll truck that down the existing haul road, which you can see here, it's a little bit hard to see, but down to the new processing plant that's going to be built down here. The second pit that we'll be mining is the Gilbey's deposit. And the discovery we made just a few months ago at Sly Fox, a potential third pit, is less than 1,600 metres away from the processing plant. That's just how underexplored this whole area is. This is just the postage stamp in the middle of the project so far. Our properties extend for 40 kilometres to the north, 30 to the south, and east-west in excess of 25 kilometres. So it's a very large area, and we're really only just scratching the surface. We'll be building a brand new processing plant. We are building a brand new process plant, 2.5 million tonnes per annum, and it's capable of over 3 million tonnes per annum when we're treating the soft oxide material for the first few years. We've got a lot of additional infrastructure already on site. There was a small pit mined here in the past, and we've got a lot of the infrastructure already in place, the bore fields, the tailings dams and so on. So it gives us a huge free kick, if you like. There are really a number of things that separate us and are key to the development of the Dalgaranga project. And if I can summarise them really in two words, it's simple and conventional. Now that's really important because that simplicity and conventional nature of the flow sheet reduces costs, reduces risks, reduces not just the operating costs but also the processing costs. The capital cost is substantially lower than you would normally expect for a 2.5 million tonne plant. That this is the southern face of the Gilbey's pit, and you can see it's very deeply weathered. There was 70 metres, when they mined this previously, 70 metres of free dig material, no blasting required. That reduces your mining cost and reduces your dilution. The other thing you can see is you can actually visually see the ore body. Now, I'm doing that now deliberately because in a moment I'll actually show you what it looks like. It's a wide ore zone, up to 45 metres wide in the main zone. That reduces dilution, reduces mining costs because you're looking at bulk mining. It saves an enormous amount of money by doing this. As a result of that, increases margins. Excellent historical metallurgical recoveries. The plant, exactly the same flow sheet that we're building. Last time achieved around 94.9% recovery, so very, very high metallurgical recovery through a very simple process. And we have all that historical operating data to support the information we have going forward. So high margins and simplicity. Looking at the flow sheet itself, it is about as simple as you can get in terms of a gold mining flow sheet. We have the ROM pad on the far right-hand side, one single jaw crusher, a transfer point and a crushed ore stockpile. That then feeds across to one single SAG mill, a high gravity gold component, and we get between 35 and 45% gravity gold recovery. Again, reduces reagent consumption and reduces costs. Then we've got the leach tanks, very rapid leaching, so we only need relatively small leach residence times. And this plant, very simple plant, is able to do in excess of 3.2 million tonnes per annum up to in the first few years. We're only factoring in 3 million tonnes per annum, so we've still got some operational flexibility to up production further. On top of that, the standard types of infrastructure you'd normally expect around an operation. So I'll very quickly run through the project execution because I'm mindful that time is somewhat limited. You can see since the feasibility study we've employed a very experienced development team. We've moved from 80% ownership when we finished the feasibility study now to 100% ownership with no private royalty to the former joint venture partner. We've moved to an EPC construction model that reduces the cost risk for the project, and we've already ordered a lot of the long lead time items: the camp, administration offices, the SAG mill, which is the longest lead time item for the actual project, has been ordered about 8 weeks ago. Gravity gold circuit, kilns, elution circuits and so on. So a lot of long lead time items have already been ordered. We've done a $55 million equity raising in March of this year. So we've got all of the equity portion of the funding required for the property. So we don't need to dilute our shareholders any further. Debt financing discussions are well advanced, and we're hopeful that we'll have those finalised in the next 6 weeks or so. And that will see us charging full steam ahead. The Dalgaranga, the village construction and installation is 60% complete, and the bulk earthworks mobilisation has commenced, and they're actually on site next week commencing. So this is what the construction camp looks like so far: 56 rooms as a temporary facility. But the 240 room camp is already on site and is 60% through construction. So yeah, we are moving ahead rapidly towards the development. On top of that, as I mentioned, project optimisation is very, very important to us. We've now shown by increasing the throughput when we're treating the softer ore, we will see 244,000 ounces produced in the first 2 years, increasing substantially the early cash generation. Rapid payback, high margins. The reserve has been increased, and the project is now fully permitted, ready to go. And we are, as you saw from the last photos, certainly moving forward with it. We've made slight adjustments to the flow sheets to reduce operational risks and ongoing operational risks as well. So we're managing that very carefully going forward. What you can then see as a result of that is 120,000 ounces in the first few years, and then stepping down at this stage to 80 to 95,000 ounces. And the green here is the Sly Fox discovery. What we believe we'll be able to achieve out of Sly Fox should lift the production rate to in excess of 100,000 ounces for the first 5 years at least, and that's without any exploration success. Now, the chance of us not having any exploration success, in my opinion, is zero. We have continued to show that we can grow this asset. When we first acquired this asset, we had 300,000 ounces within it. We've added 1 million ounces to this project in the last few years, and importantly, at a cost of under $10 Australian an ounce. An incredible outcome and an incredible effort by our exploration team to do it as cheaply and effectively as possible. What that also shows is the fertility of the project, to be able to do it so cheaply and grow the resource base so rapidly. So we're certainly growing. We'll see additional growth and mine life growth. I have no doubt we'll be mining here for far in excess of the 6-8 years so far. I think we'll be 10, 12 plus. Very quickly, looking at the Sly Fox discovery, it was discovered in March of this year, and the confirmation of that then moved forward into resource within a few months of discovery. We've drilled out only the first 270 metres of strike length so far, and we already have 77,000 ounces. Now, it's not a huge number of ounces in the overall scheme of things, but what it allows us to do is just build that production profile now for year 3, 4, and potentially year 5 as well. So it really helps cement the property going forward. You can see a number of wide ore zones within this ore zone, and it comes right up to surface. So very consistent grades, consistent widths, wide mining again, lowering the risk. We've already done metallurgical test work on this deposit. The recoveries are up to 98% recovery, so fantastic recoveries. Low reagent consumptions, and a maiden reserve we're aiming for in the next few months as well. So certainly been moving aggressively forward with it. But that's really just the start. And as I mentioned earlier, we've got a large tenement package here. The Gilbey's deposit sits in this is an aeromagnetic image. The Gilbey's deposit sits here. It then appears to have been folded around, and Sly Fox then trends this way here. And Sly Fox itself is that small little square there. Now, if you zoom out to not all of our package, but probably only about 20% of our package, you then start to see Sly Fox is that little dot there. We own everything on this map is controlled by Gascoyne Resources. You can see a structure that appears to come down through here, fold around and continue through here. That has not been drilled at all. The closest drilling to that structure is at the Seagram's deposit, which was drilled a few holes were put in 1994. No drilling's been done on that entire structure since. So the potential for substantial growth, either at a number of one of our prospects, really is outstanding. We've then also moved to start using more science into our exploration techniques. This is an EM survey, electromagnetic survey, to identify the more conductive horizons. Now, black shales are associated here with the mineralisation, and you can clearly see that same structure I showed earlier folding around here. And so there's plenty more potential along that trend between Sly Fox to Seagram's, around and back through here. There's also a number of other regional prospects we have at Tanqueray, Hendricks, Bombay, Beefeater, Vickers, and so on. So anyone who can come up with some more gin names for our next few prospects, please come and see me at the booth. I'm always after more names to name more prospects after. So there's a huge potential here for a lot more growth, and it will continue to grow as we produce. As I did mention earlier, I would like to just very quickly discuss the Glenberg project. This is our growth asset, and it's quite unusual for any company, whether it be a development company or a production company, to have in its back pocket another 1 million ounce project to develop next. Now, of the companies that Yerk actually put up, the Australian companies there, only I think 2 of them have plus, and they're all plus $1.5 billion companies. Only 2 of them have growth assets that have 1 million ounces within them. So on the ASX in general, there are only about 5 companies who have got, and this is going from exploration companies all the way up, a growth asset of another 1 million ounces sitting there in the wings. Now, Dalgaranga is a very different project. It's not a traditional greenstone hosted rock. It's what they call a shield margin. Worldwide, these systems are very large systems. There are a number of them around Canada, in India, Zimbabwe, and in Australia. The closest analogy to us at the Glenberg project is actually the Tropicana deposit that's owned by Anglo Gold Ashanti and Independence Group. And that's an 8 million ounce system. That's on the southeastern contact of the Yilgarn block. We're on the northwestern. So they tend to be very large systems. And you can see here, this trend here, all on our ground, extends for more than 70 kilometres. Now, it's a massive area. I'm afraid I don't know Geneva well enough to know what is 70 kilometres away from here, but it's clearly a very large system that needs to be drilled substantially. Within that, those little black dots there, all the drilling that's been done on that entire lease, on that entire area. And that has already identified 1 million ounces. Now, the other thing that's really important for us is to identify the architecture and the age of the mineralisation and the architecture when the mineralising events happened. So we've done a lot of work to identify the age of the rocks and the age of the mineralisation. And the reason I'll mention that now is it's very important to understand that, to then have the model to understand and have the potential of how we move forward. So the next slide, I'll put an aeromagnetic image up and a bit of an animation to show you the model that we were working to and how it projects. So you can see an aeromagnetic image here. You can see northeast of this high magnetic unit. This is the architecture when the mineralising events happened. If you then plot where the deposits lie, you can see there are 3 subparallel trends. If you fast forward geological time 2 billion years into around 10 seconds, it then moves into this area here. What you can then see is these areas here are where we have the deposits. There was nothing down here at all. That area down there We've now done drilling exactly where the model suggested it. And we've now got 85,000 ounces exactly where it was projected to be. Directly along strike from our highest grade deposit at the Zone 126 deposit here, we've got a 6 kilometre long soil anomaly, completely untested. So the potential for this system is far greater than the million ounces we currently have. Approximately 30% of the 3 combined trends have been tested to date, and we already have 1 million ounces. Now, a number of people would say, well, why aren't you aggressively drilling here? And it's a very good point and a very good question. Why aren't we doing it? Part of the reason we're not doing that is we want to protect our shareholders and protect our capital structure, something that I think a lot of the Australian companies don't do as well as they should. So we have got a lot of these targets. What we're doing is getting the Dalgaranga gold project into production, into cash flow. We can then continue to the aggressive exploration here, grow this project to the ultimate size that it could be. Even if we don't find another ounce here, and the chances of that are 0, but even if we find no more ounces here, we've still got a project that will be a 5-year life, producing 80 to 100,000 ounces per annum, which will give the company as a whole 11 years of life. Or we have Dalgaranga going at 120,000 ounces, bring Glenburg online while we're still mining Dalgaranga, and grow to 200,000 ounces per annum. That's our intention, to bring Glenburg online while we're still mining Dalgaranga and grow the company to a 200,000 plus ounce producer. So moving forward, we've got a lot of work going on. Excuse me. A lot of news flow coming, and we are fully funded, so it's going very, very well. The capital structure, as I mentioned earlier, 370 million shares on issue. We are tightly held. Board and management team, we own 11% of the company. So we are very aligned with our shareholders, and we'll do everything we can to protect them. So in summary, we are a gold development company in Western Australia, 100 to 120,000 ounces per annum from our first operation at the Dalgaranga project. We'll then, from the cash flow generated from that, build our Glenburg project and grow towards 200,000 ounces, while still the other aim we have got is ultimately to be a dividend-paying company. And the cash flow generated and the margins that are available from these assets do allow us to grow that company and go forward. So a fantastic opportunity. Thank you for the organisers for the opportunity to come. And if you'd like to ask me any questions, please feel free to come and see me at the booth, and more than happy to answer any of your questions. So thank you very much.
So we're going to leave Australia and go back to Canada. Saskatchewan, I have the honour of presenting Mr. Jordan Trimble of Sky Harbour Resources.
It's all working up there.
It should be. I'm just going to go F-share. Why I have a little issue over here. PDF. I think that's going to be better. I should have done that one. So, did I call you Jason? Jordan. Jordan Trimble. I understand he's probably one of the youngest CEOs on the TSX venture in Canada. He has a bachelor's degree in science and also an undergraduate degree in commerce from the University of BC. Very just shortly, he was involved with the Bayfield Ventures, which was sold to New Gold. And so he's had success in the past, and he's going to introduce us to Sky Harbour Resources, which is involved in the Athabasca Basin. Mr. Jordan?
Perfect.
Thank you. Move forward in the front dock.
Okay.
Perfect. All right. Thanks, Eric. Thanks for coming out, everyone. Bit of a change up here. I was with a gold company, as Eric mentioned, called Bayfield Ventures. What we did with Bayfield, which is exactly what we're trying to do here with Sky Harbour, is explore, discover, delineate a resource, and ultimately look to sell the company. We did that successfully with Bayfield, a gold project in Ontario. We were acquired by a larger gold mining company called New Gold. At the time, my team and I in Vancouver were looking at starting a new company. I did a lot of homework at the time. I was looking at getting back into the precious metal space, doing that again with Bayfield. But what really stood out to me at the time was a real contrarian, deep value opportunity in the uranium sector. And it's a very interesting space. It's a very misunderstood space. But at the end of the day, I'm a big believer in the commodity. I'm a big believer in nuclear. I think it's here to stay. I'll tell you why through this presentation. And most importantly for us, we saw two things. One, a commodity that had basically been decimated, both the price and the equities, the mining companies, by what was really a couple of black swan events, but obviously Fukushima. And we saw a sector that basically had a mass exodus of companies. When I'm looking at the other commodities, there's a lot of different products, companies you can invest in, and that's what I really liked about uranium. And still to this day, it's gotten even more so. If you're looking to get investment exposure to that commodity, it's very limited. There's a lot of governments, obviously, and state-run enterprises that manage these companies. There was a lot of consolidation at the top of the market back in 2010, 2011. So there's really only a handful of us left. You're not buying physical uranium unless you have a massive fund to do so with. There's basically two ETFs. So really, at the end of the day, where is investment capital gonna park money when this sector turns around? And it's going to be the mining companies. And so our philosophy is go out there, acquire projects at attractive valuations. We've been able to get our hands on some incredible assets in the #1 mining jurisdiction in the world, which is Saskatchewan, as ranked by the Fraser Institute as of a month ago. Acquire these projects, build a team with focused expertise on your high-grade uranium exploration and discovery in the Athabasca Basin. We've done that. Bring in strategic partners to help fund the exploration on some of the other projects. Our largest shareholder is a company called Denison Mines. They're the 5th largest publicly traded uranium company in the world, dual listed on New York and TSX. It's a Lucas Lundin company. The president and CEO of Denison Mines, a gentleman named Dave Cates, is on our board. We have a very close working relationship with Denison. Secondly, we consummated a deal with a company that probably a lot of you are familiar with just across the border here called Areva. So we have a strategic partnership with Areva. They're acquiring a project of ours in the basin as well. I was just in Paris at their offices. So we've been able, for a small company, to partner up with some big names, which is key. So I'll get into the presentation. I'll talk a little bit about uranium. I know it's a hot topic. I'm more than happy to talk more about it because I won't have enough time here. But I really do want to focus on what are the key catalysts for Sky Harbor, right? If you're looking at it as an investment opportunity in a bear market, why are you buying shares of this company? So I want to start, I like to focus on really the 3 pillars of the company: people, timing, and projects, right? And people with these companies, as we know, is arguably the most important ingredient for success. When we started this company 4 years ago, that was really the first mandate we had, was to put together a team that knew how to go out there, find these deposits, most importantly at the time actually be able to raise the capital to go carry out uranium exploration, but find the right technical team that has, again, focused expertise in the Athabasca Basin. It's great having hundreds and hundreds of years of experience in the industry. As you can tell, I don't have hundreds of years of experience in the industry, but I have a team that has very focused expertise in the Athabasca Basin. So as Eric mentioned, I'm based in Vancouver. I come from more of a finance background. I was with Bayfield Ventures. I worked with a few mining companies in the past. Started this company about 4 years ago. I work with Jim Pettit, the chairman, who has a few more gray hairs than I do. Him and I work together in Vancouver. I want to highlight, though, my head geologist, Rick Kazmersky. Rick is a 40-year veteran in the Athabasca Basin. He knows how to go out there. He's found multiple deposits in the Athabasca Basin, high-grade uranium. He was with Cameco. He was actually the exploration manager for the world's largest publicly traded uranium company for about 15 years. Senior geologist at Cameco. He left Cameco in 1999 with a vision much similar to what I had 4 years ago, starting a junior uranium company called J&R. If you had bought JNR in 2000 when he started it at a $5 million valuation, it moved up to $500 million in 2007, and that was on the back of discovery and on the back of an improving uranium market. He ended up selling JNR to Denison Mines, and that's where it's come full circle. We have that relationship with Denison Mines as our largest strategic shareholder. David Cates, he's the president and CEO of Denison Mines, UPC as well. Again, one of the largest publicly traded uranium companies. He's on our board. Very close working relationship with them and their team. Our flagship project is very close to Wheeler, which is their flagship project. Wheeler will likely be the next producing uranium mine in the Athabasca Basin, and there's a lot of operational synergies, potential operational synergies between our flagship, which is called Moore Lake, and Denison's flagship, Wheeler. So very important member of the team, also a large shareholder. Last but not least, I want to highlight a gentleman named Paul Matizik. Some of you are probably familiar with Paul. He's very well known in our industry. Paul's built and sold 4 mining companies in the last 12 years. He really is a titan, and most importantly for us and our shareholders, he knows how to get these companies sold. Again, our mandate here, our whole business model, build this company up, delineate a resource, make discoveries, and sell the company. Paul's done it 4 times, and his biggest win was a company called Energy Metals, a uranium company, $10 million in 2004. A short 3 years later, he sold it for $1.8 billion to Uranium One. So Paul's a very large shareholder. He's a strategic advisor to the company as well. So just quickly, before I get into uranium market and our projects, you can see we have a listing TSX, Venture, Frankfurt, as well as in the US. We have a pretty large US shareholder base now, 53.5 million shares out. It's a small cap company, right? This is the opportunity. I mean, we are trading where uranium is trading at right now at a significant discount. $23 million market cap Canadian. We just raised some money at about a 40% premium, no warrant to our current share price. We're trading around 44 cents Canadian. We raised money at 60 cents, mostly institutional. The lead order was actually a fund out of China. We've seen a lot of Chinese money coming into the Athabasca Basin recently. Some of the other larger shareholders down here, I won't go through all of them. Some of you might be familiar with Marin Katuza out of Vancouver, well-known resource investor. He's been the cornerstone investor on this company from day one. Behind Denison Mines, he's the second largest shareholder, him and his fund. So the uranium market, I'll try to give you the Coles notes as much as I can. I'm more than happy to talk more about it. But when we look at the uranium market right now, there's a simple fact that really stands out. You have a $20 a pound spot price right now. At $20 a pound, not one single producing asset in the world makes money. So just think about that for a second. Not one mine is profitable at $20 uranium. The lowest cost producing mine, the Inkai mine in Kazakhstan, is break even at $22.50. The only reason these mines are still operating is because a lot of them have these long-term contracts at higher prices. 80% of those contracts expire in the next 6 years. So what's going to happen when those contracts roll off? One of two things. Either the mining companies are able to negotiate higher prices with the fuel buyers, or they shut down production. Shut down production, that's bullish for the spot price. We've seen just in the last 6 months a number of notable production cuts, one of which being out of Kazakhstan earlier this year. That's where you saw the spot price jump up and all the equities follow suit. There's a lot of speculation out there right now that Kazakhstan will make another production cut, given that they're not making any money at $20 uranium. The average all-in cost globally right now for all the operating mines is about $41, $42 uranium, double where the spot price is. The price needed to incentivize new mines to come online, pipeline projects to be built, is $60 to $65 uranium, triple the spot price right now. So when we talk about there being a contrarian opportunity, I think this is one of the best commodities out there for that. If we look at the supply-demand picture, you have here 180 million pounds of annual demand, 160 million pounds of annual primary mine supply. We're already in a shortfall. Now, why has the price deteriorated as much as it had and hasn't stayed low? Simple reason, secondary supply. There's been a lot of secondary supply. There still is a lot of secondary supply, and that's what's been hurting the market. So we can't pretend that that isn't there. But as we've seen in previous cycles, you look at the period from 1999 or 1998 to 2004, you look back in the 70s, even the 50s, when you do have secondary supply that keeps prices depressed, and eventually when those secondary supplies subside, you just didn't have the new mines coming online to meet that demand. And that's exactly what's happening, unfolding right now in the uranium space. You do not have any meaningful new mine supply coming online in the next 5 years. The biggest two mines that recently came online, Cigar Lake in the Athabasca where we are, and Husab, which is a Chinese mine in Namibia. And Husab has had a whole bunch of problems. Their average cost, a lot of people are guessing it's around $60 to $70 a pound. It could even be higher, speaking with the people at Areva the other day. So it's an interesting scenario playing out, very compelling supply demand. The demand side continues to grow. This is something that a lot of people misunderstand. Demand is growing in China, in India. A lot of people don't know this. More nuclear electricity capacity came on the grid in 2016 than any year in the last 30 years. The Chinese right now, 58 reactors under construction. The Chinese are building 18 of those. These new reactors, they're much bigger, they're safer, they consume a lot more uranium, but they're under construction. We're not talking about what could happen 20 years down the road. We're talking about what's happening right now. 58 reactors under construction. They consume more uranium than the old Gen 1 reactors, and they're online in the next 2 to 3 years. As I said earlier, Kazakhstan on the supply side, low prices is starting to affect supply. We're seeing big producers cut supply. We will continue to see that, and that'll be positive for the spot price going forward. So I'll skip over here. This slide, I think for all of us in this room, for all the precious metal bugs, this is a very important slide. I want to highlight this, right? So for those of you more familiar with gold and silver companies and grades of deposits and all that, make a note of this slide. This is why we look for uranium in the Athabasca Basin. It's the highest grade depository of uranium in the world. It's a geological anomaly. It's in northern Saskatchewan. Look at the grade equivalent of 1% uranium, 20 grams per ton of gold, 1,400 grams per ton of silver, almost 14% copper. 1% is a mediocre grade in the Athabasca Basin. We just finished a drill program, our first drill program at our flagship project since acquiring it last year. We had a drill intercept that returned 6% over 6 meters, and within that we had 21% over 1.5 meters. That's equivalent to 420 grams per ton of gold. Very, very high grade, very rich ore. And that's where you get the low cost. That's why the Athabasca Basin is a low cost producing region in the world, because it's very high grade. And for exploration companies, I'll go to this slide here. This is what excites me. Let's assume the uranium price stays at $20 for the next 2 years. Why invest in Sky Harbor? One simple reason: discovery potential. Take NextGen, take Fission. A lot of you are probably familiar with these companies that have had discoveries in the last few years. NextGen Energy has gone from a, $30 million market cap to over $1 billion in the last 3 years, while the commodity has gone from $45 to $20. Why is that? High grade discovery, world-class discovery that they made. Similar story here with Fission, with Alpha. This just shows you don't need a booming commodity to create value, to create wealth for shareholders. That is the model here at Sky Harbor. We have the team to do it, and that's what we're going after on our flagship project. So if you go over, to this slide here, this just shows you, just to finish off on the projects, 5 projects scattered throughout the Athabasca Basin. This has taken us the 4 years to build. Again, we've been very opportunistic in acquiring these projects. You'll see here on the east side, so this is where the infrastructure and mills are, Moore Lake. That's our flagship project. We acquired that a year ago. So we just finished this drill program. There's high grade and, most importantly, shallow uranium mineralization at this project. We're proving up. There's a small deposit there. We're expanding it. We're also looking to make additional discoveries on this project. There's a lot of upside potential there. There's a lot going on geologically. One of the things we're looking at doing, for those of you familiar, I won't get too much into the geology, but in the basin you have basically 2 types of deposits: unconformity or sandstone hosted, and then basement hosted deposits. The new exploration and techniques and methodology and thinking has been looking for your high-grade uranium in what's called the basement rock. That's NextGen, that's Fission, that's Denison's Griffin deposit. This project, a lot of the historical drilling done back in the late 90s, early 2000s, they were not looking for high-grade uranium in the basement rock. All the high grade that's there currently is at the unconformity or in the sandstone. So a lot of these bigger, higher grade deposits that have been found recently, all in the basement rock, that's one of the areas we're gonna be looking at at Moore Lake. So that's the flagship. That's where you're gonna see the most news flow. That's where we're spending our money. We got, as I said, just under $4 million, $2 million in drilling over the next 12 months, probably be about 8,000 or 9,000 meters of drilling. So lots of news flow. We saw earlier this year good drill results, and the share price responded quite positively. On these other projects that you see here, 4 other projects, a lot of property, very, very highly prospective ground. This one project, Falcon Point, has a 7 million pound NI 43-101 compliant deposit, as well as a thorium credit. What we're looking to do with these projects, instead of us having to go raise money in a difficult market, dilute, we're employing what's called the prospect generator model. And some of you are probably familiar, have heard this prospect generation, right? So what we do is we go out, we find strategic partners to come in. We'll sell a portion of the project, they'll earn in, they'll fund the exploration for us, typically pay us some cash in stock each year, so we actually generate some cash flow, and we end up with a minority interest in the project at the end of the day. This is exactly what we just did with Areva. Areva is now buying 70% of a portion of Preston for $8 million over the next 6 years. We will retain a minority interest. They'll be funding all the exploration. It's also great because we get to leverage their geologists, their technical expertise, without me having to go out and hire 100 geologists. We get to use Areva's geologists to do the work there. So it's a great model to de-risk, to also basically put more irons in the fire. We're gonna have multiple exploration programs between our drilling at Moore and our partners working at these other projects. We then did a deal with another company called Azincourt, similar structure to what we did with Areva. We're looking to consummate deals on these other projects as well. So you have not just the catalyst of us drilling and the discovery potential that we have at Moore, but these other companies too, and they're funding it. So we don't have to continuously raise money. In fact, we can use some of the cash payments coming in to help pay for our drilling at Moore Lake. So it's a unique model for Sky Harbor in that we offer that discovery potential, similar to what NextGen, what Fission, what Alpha, what Hathor, which was bought out by Rio Tinto, what they offered their investors early on. But instead of just letting the secondary projects sit there and collect dust, we're employing the prospect generator model. We've brought in an industry leader like Areva on one of the properties. We're looking at other deals with other companies as well right now. So I'll just quickly finish off here. So this just shows you, pull it up here, the chart. So this is where we can see we've been quite active this last 12 months, despite a difficult uranium market. We've been moving forward. You'll see here, this was the deal we did with Denison. Obviously, market responded quite well. This was a consolidation. The uranium price basically capitulated there. It actually hit just under $18 a pound last November. In inflation-adjusted terms, the lowest the commodity's ever traded at. We did the deal with Areva, and then here were some good drill results. So the market's pulled back a little bit in the kind of low to mid 40s. We raised some money at a higher price. We're starting our next drill program in August, so you'll start to see news flow coming out, drill results coming out from that. Azincourt and Areva will also be working the other project here this summer as well. So lots of news flow, lots to look forward to with the company. And as I said, we're also looking at forming other joint ventures, other strategic partners coming in as well. So to finish off, just to highlight people, the right team, focused expertise in the Athabasca Basin. Rick and his geological team in Saskatoon have made multiple discoveries in the basin. They know what to look for. One of the other things that's important to note too, new technologies and new innovation, new methodologies that have been used in the basin in the last 10 years have yielded new discoveries at lower costs, right? New geophysical techniques, new types of drilling, right? So we're geochemistry. Knowing the geochemistry is a huge thing in the last 10 years. So we're employing all that to help make the discoveries. Timing with the uranium market, I think we've seen a bottom. I think we're coming out of it. And last but not least, projects. Our flagship Moore, the 4 other projects which we're partnering up with strategic partners on. Lots of catalysts, lots of news flow. So as I said, I'll be at the booth. If you have any questions, if you want to talk uranium, if you want to talk exploration in the basin, more than happy. Thank you very much.
Well, I can really confirm that Saskatchewan is one of the better jurisdictions. With the news that came out of Quebec really this morning, I won't go into details, but there was a judgment that went against an uranium company. So Quebec will probably go down with the rankings. I'm most unfortunate, but that is what it is. Comme on dit in French, c'est la vie. So I have the honor of presenting our next keynote speaker, Mr. Thomas Lagré. He's the Director of Metals and Mining for BNP Paribas in Paris. He was in New York from 2006 to 2010. He's been in Paris now since 2010. He will talk to us about the debt structuring. And so I have the honor of inviting Thomas to the podium.
Thank you. All right, I'll try to be as enthusiastic and passionate than the last speaker, despite the fact I'm a banker. So I'll try to bring some good ideas on the screen and in my speech. I'm not there to sell my story and sell my stock. I'm there to share the way the banking industry is looking at the mining sector, and probably to share the checklist that we have on our side. You see the title of the presentation is quite simple, Dirt, Debt, and Dividend. We believe that the reason for success is that to make sure that the three dirt, debt, and dividend, the three aspects, share their checklist for success. You have a lot of very good GOs and technical teams, and they have their own checklist for success. You have a lot of very good investors, shareholders, CEOs, and they have their own checklist for success. And then you have the debt providers, and we have our own checklist. The idea is to make sure you don't wait for the last minute to get to know that checklist. You have to compare and start early your process and make sure you do everything from the start right. So I will give you a quick update on the debt market because we all think that the debt market is dead. The equity market has been difficult. There is a belief that the debt market is still dead. I will give you a quick update and then I'll move on to more the way the banking industry is looking at the mining project, and I will share with you the checklist that we have on our side when we go to credit committee. Okay, the debt market has been impacted by a variety of factors. You know that the banking industry is facing a lot of headwinds, regulatory constraints, balance sheet constraints, higher political risk environment limiting the appetite of some banks on some of the countries, liquidity costs going up, due diligence requirements on the compliance side, on CSR topics. That's not a new part of the process, but that's getting more and more important within the way the banking industry is looking at the sector. You have lower prices in parallel, so that doesn't help. You have a lot of question on, okay, is it the right risk return? Is the mining industry, is it an industry the banking want to do more? There have been a lot of internal debate within the banks, and that's not only BNP Paribas, but the mining banks have been looking at the sector in greater detail. And the consequence you see on the top right chart, there's been a strong decrease on number of mining deals being financed, both in terms of size and number over the last 3 years. And the chart at the bottom left shows you that the average maturity of the deals has been reduced as well. In the past, it was quite easy to tap the debt market for 5-7 years, up to 10 years money. Over the last 2-3 years, the liquidity has been scarce, and the average life of the debt financing is probably more in the 3 to 5 range estimate. So that's new, and you have to take that into account. Last but not least, on that chart, you see the trend of the debt market is more focused on the refinancing at the moment. That's the blue part of the chart, while the capex development, the gray and the orange for the project finance, has been reduced dramatically as well. Meaning that we probably losing some expertise in project financing. We good at it because we spend time on deals and projects, and if we have one success, we'll be good for the next one. If there are no new project finance in the market, the banks will lose the expertise. You see that some of the banks have closed their mining teams. The number of banks or number of funds with mining expertise is reducing. And when you're going to go to the market to get your debts done, you're going to have a small list of expert players. So that's where we stand. A quick summary on how, again, ourselves on the debt side, we see the challenges and opportunities of the mining sector. First of all, there's been a change which is good for us. The mining companies are moving from a volume approach to a quality and a margin approach. So they are targeting smaller projects, smaller capex, smaller or shorter construction periods. At the end of the day, you have probably more certainty on the funding sources, and you reduce the complexity of the project. The big names, you name them, Anglo, Barrick, Newmont, they have been reducing their number of assets, divesting part of their non-core businesses, reducing the balance sheet. So that had an impact as well, but that's a positive impact in terms of credit appetite or credit strength of the players. Obviously, the FX and the fuel price had a strong impact, especially in Africa, for instance, or in emerging market, and that's positive, and that's a positive thing that we see on our side when assessing the credit of the mining players. And on the other side, you have a new thing that says, okay, mining, that's part of the real industry. So we as a banker, we have to finance the real industry. So that's why we're imposing new CSR requirements. So don't complain too much. I think the reason for the banks to impose or to force the due diligence on CSR topics is because we believe that's good for the companies, that's good for the planet, and we trust that mining is part of the real industry. On the other side, political environment has changed a lot. You name the countries like Turkey. We've been doing a lot of stuff in Turkey. We're a bit more careful at the moment. West Africa, we're still very active. South Africa, you saw that last week, the announcement of the mining minister. So political risk environment changing a lot, and higher risk doesn't help the debt markets. On the pure financing aspects, I think it's fair to say that the debt market has been difficult for the juniors, while the debt market was waiting for it. So the equity and the debt piece has to work together now. In the past, the junior mining companies, they were tapping the market in Toronto or in Perth every 6 months for $20 million, and then they were just waiting for the last minute to engage with the debt providers. We believe that we need to form a common discussion. That's the reason of my presence today, and that you get to know how the debt providers will be assessing the project in probably 2, 3, 5 years, but at least you take that into account now. Okay, quick summary of the funding sources. So that's really a snapshot of the current debt environment for the mining sector. Have 4 categories of funding sources. The first one, commercial banks, and you know them, the European banks with expertise in the commodity sector, BNP Paribas, Société Générale. You have the Australian like Macquarie, the South African as well, the Canadian players. Commercial banks can go up to 7 years. Beyond 7 years, that's going to be tricky. The pricing will increase, or there will be no appetite at all. The drawback of that liquidity is that you have to follow the due diligence requirement of the banks. Then the second part, and that's something pretty new, we call them the new funding sources or the non-bank finances. That's something that came in the market over the last 2-3 years. Royalty companies, streaming companies, private equity funds, mining funds. They're bringing what? They're bringing the expertise, they're bringing liquidity, and they're bringing the speed of execution. So for us as bankers, these are real competitors. They move fast, they do deals quickly. You saw the deals announced by Orion Mine and BlackRock in Ecuador with Lundin. It's a full package. They do that with probably lower due diligence requirement than the banking industry, but they provide a full package done. They've done the same in Armenia with Lydia Mining, and they provided a full package, debt, equity, stream, offtake, everything. They can go up to 10 years. Then if you want to add some political umbrella in the structure, you can move to the discussion with the export credit agencies, more on the back of the capex and the sources of equipment. Korea Exim, for instance, Finvera, US Exim, EDC will provide cheap money for the long term. And last but not least, you have the DFIs, a bit scary sometimes by the number of due diligence requirements that they impose on the companies, but working with the IFC, World Bank, with the African Development Bank sometimes can help mitigate the political risk in some countries. We have done deals in Guinea, Conakry on the bauxite, and I can tell you that having IFC on board was a great reason for the success. Okay, last slide was the funding sources. Now on the financing structures, basically you can, when you go to the market, you have 3 ranges or 3 types of financing structures. The first one is the one you know probably, the more project financing for juniors. That's the where really the expertise in the market is. And for junior mining companies, you can easily raise at the moment $200, $300, $400 million. We've done this in Mexico with Torex. We've done it with Rox Gold in Burkina Faso. We are looking at it with Gold Road and Guerrilla Mining in Australia. So that's really on the market, available for mining companies, and the pricing is quite cheap. 5-year money will cost you all in 5% probably. For the larger sponsor, like Rio Tinto and the big project in Mongolia, you can raise a couple of billion, and we have been doing the Oyu Tolgoi financing for the last 5 years. Then moving to the more corporate debt part of the financing structures. There, that's more for the existing players, like the First Quantum of the world. It's not a pure plain vanilla financing. It's more a structured facility. You can raise probably a couple of billion as well in the market, especially if you have development capex or expansion that you want to put in place, and the banks would be quite keen to finance this. And last but not least, that's more on the M&A front. That's where probably the big banks like Citibank, HSBC, Barclays will be joining the mining sector. That will be in support of the big M&A transaction like the one with Sibanye Gold and Stillwater Mining that we did earlier this year. You see that there is a but at the bottom. Oops, sorry. We believe that for juniors there's still a funding gap between the time you have the full fees and you raise your equity to finance the fees, the feasibility study, and the time you're ready to start production. You have a lot of CPs or permitting process to wait for, and sometimes the mining companies are just waiting for the government, for the equipment to come, and there is a funding gap that for the moment has not been addressed properly. That's a summary of the timetable and for mining projects. And really the point here on my comment is the fact that we are not working in sequence. The project finance discussion can start right at the time of the project development. Once you have a good idea of, okay, what's the project, do you have a point on the map, location, a couple of figures in terms of size of capex and production, it's very good that you can start the debt discussion, even though the funding will come at the last part of the process. So that's really the message. That part of the timeline is where probably the CEOs has to be smart enough to talk to the debt and the equity providers. Okay, the to-do list. So that's quickly the to-do list of the credit committees. When I go to credit committee presenting a mining project, that would be the question. Okay, where is the company in the country? Do they have access to infrastructure, power, water? How they compare with peers? Key metrics. I don't want to go into details of complex elution circuit or work index. Give me just the grade, the volume, the cash cost, and that's it. Management and staffing, and I think that's critical as well for you as investors. Who are the guys in front of you? Is it a good team? Are they working well together as well? That's a good reason for success. Then the second part is to make sure the company has started everything a bit early, not waiting for the last minute to prepare the document for the banks. So going into the detail of the CSR aspect, technical, do you have a technical report to share with the banks? The banks will fund only at the to-be reserve stage, but we're quite keen to be discussing the financing even before that. Next one, and that's important as well, the bank are a bit scared when there is a company changing its strategy or its mine plan or its name every 2 years. So we like consistency, we like a clear vision and a consistent strategy, and that every year we hear the same story. That's quite important for us. If you tell me that you're going to go to the market in 2019, don't change that or don't come before, because I'll be suspicious. And as you progress, and that's probably the fourth point, as you progress with the equity story and the development of the project, talk to your banks, talk to the debt providers, talk to the funds, and just tell them your story as well, and see how they react and see how they see the market, what are the terms available, even though that's going to be in 2, 3, 5 years' time. That's constructive for you, and you can share that with your equity investors as well. And the last point, obviously, if you want to build a small mine, you don't want that big truck there. So don't try to be fancy or add some complexity to something that's already sophisticated. Be simple. As a CEO or as a CFO, you want something that you can explain to the shareholders. If you go for hedging, then make sure you understand how it works. If you go for a stream, make sure that you can explain to your auditors and to your shareholders as well. Keep it simple and keep it close to what you know. I won't spend too much time on that pros and cons on project finance. You know that project finance is a very good way of sharing risks. It can be slow, it can be costly in terms of due diligence. At the end of the day, you can leverage the asset. You can go up to 70% debt probably. And as I mentioned, you can raise, at the moment, USD for 5 years, around 5% all in. All right, I'll finish up on probably BNP Paribas and the setup. So I'm part of the mining team. We have a global franchise of 25 people. We do have the expertise in the field. We do project finance, but not only. We do acquisition financing, we do structuring, and we're more than happy to provide free services and free advice and talk to the companies, even though it's not the time when you need the debt to be put in place. Important to mention, we have a strong presence in West Africa, and we go there. I'll show you on the picture. Yeah, I'm not collecting the interest. That's not the way we're collecting the interest, but we go on the mines. We visit the countries. We know the countries. That's critical as well as debt providers. We're not just lending money out of London or Paris on the basis of an Excel spreadsheet. That's it, I think. That's
I gotta keep. Thanks, Kevin.
okay. Thank you. That was just Rock's Gold, a name you probably know. That's one of the case study, and I think a good example of success for small but simple and nice project financing. Thank you for your attention.
Je l'apprécie beaucoup. Il n'y a pas de cloque là. Ah, il y en avait hier? Il y en avait un hier? Oui. My next keynote speaker is Mr. Ben Davis. How are you, Ben?
Good.
Did you want to?
Yeah, just got a little bit of
okay.
technology.